case, please?
Good morning. It is Wednesday, February 19th. We are ready to hear the appeal of Bret Mosher, case ID 190-14157. It is 10:03 a.m.
Okay. Thank you very much. Is the court reporter ready?
Yes, ma'am.
Okay. Welcome. Just before we go on the record, I will just remind everyone that when you are speaking during the hearing, please speak up loudly and clearly so that the microphone picks up everything that you're saying. And with that, I will say that I think we are now ready to go on the record. We are on the record in the Office of Tax Appeals oral hearing for the appeal of Bret Mosher, and this is OTA case number 190-14157. Today is February 19th, 2020, and it is approximately 10:04 a.m. My name is Suzanne Brown, and I am the lead administrative law judge for this case. My co-panelists are Lynn Dang.
Good morning.
And Kenny Gast.
Good morning.
And first I will ask the parties to identify themselves for the record. CDTFA, could you please identify yourselves first? State your first and last names and your role or title, job title for the case.
My name is Amanda Jacobs. I'm a Tax Counsel 3 specialist.
My name is Stephen Smith. I'm a tax counsel 4.
And I'm Jason Parker. I'm the chief of the Headquarters Operations Bureau.
And for the appellant, please identify yourself for the record.
My name is Mark Brandeis, CPA, for the appellant, and to my right is the appellant, Bret Mosher.
Thank you, everyone. And I will just note, we are technically going out of order on the agenda. This case was listed last on the agenda, but we're starting with it first, and then once we're done with this case, the cases will proceed in the usual, in the order specified on the agenda. First, I will confirm that everyone received the pre-hearing conference minutes and orders that I issued in this case. And then I'll confirm that everyone should have received yesterday the email with the copy of the hearing exhibit binder. And I will note that, we'll get into the exhibits in a minute, I will note that I know there were some duplicate pages in there, sorry about that. All right, I thought first I would identify the issues, and then we can move on to the talking about what the exhibits are going to be, documentary exhibits, and then I'll admit the exhibits, and then once I'm done with that, I will move on to arguments. It is my understanding that neither, as we clarified during the pre-hearing conference order, minutes and orders, as it stated in the minutes and orders, and we clarified during the pre-hearing conference, neither party is intending to call witnesses today, and that still remains the case, correct? Mr. Brandeis?
That's correct.
Okay, and Ms. Jacobs?
Correct.
Okay, very good. Then why don't we just briefly confirm that the issues are still as they were stated in my minutes and orders. I have one clarification. Was pointed out by my co-panelist in discussions. I realized that for issue 3, it would have been good if I had clarified what time period is at issue, because originally in the decision from CDTFA, the issue was about both the fourth quarter of 2009 and the first quarter of 2010, but since that was issued now, the first quarter of 2010 is no longer at issue, and therefore issue 3 is only concerning the fourth quarter of 2009. And that is correct, Mr. Brandeis?
Give me 1 second, please.
Okay.
It's in the pre-conference.
Right, it just, my issue 3 didn't say what time period we were looking at, but obviously we're not going to hear an issue about a time period, about the liabilities for the first quarter of 2010, because the first quarter of 2010 is not at issue because CDTFA is no longer holding Mr. Mosher liable for that quarter.
I think there's some confusion.
Okay,
There is a liability in first quarter 2010. They dropped the liability in fourth quarter 06.
I'm looking at, for example, CDTFA's pre-hearing conference statement dated January 23rd, 2020, and it says the department later conceded that appellant is not personally liable for periods after December 31st, 2009.
That is correct.
So,
You're dropping personal liability for periods after third quarter 9?
yes.
No.
Oh,
After fourth quarter '09.
oh yes, that's correct.
So you're dropping liability in first quarter 10?
Correct.
Okay, I wasn't aware of that.
Okay, well then I'm glad we clarified, and that is why in the pre-hearing conference minutes and orders, my issue 1 states whether appellant is personally liable for the unpaid liabilities of Blue Velvet for the period of July 1st, 2006 through December 31st, 2009.
Okay, the only issue I would take there is that there is no liability from third quarter 06 to first quarter 07. And that is from schedule 12A-R2. That was already conceded by the department.
Okay. Can you repeat that time? I'm sure I saw it somewhere, but can you repeat the time?
The department has already conceded liability from third quarter 06 to first quarter 07. And that is documented in the second re-audit on schedule 12A-R2.
Okay. So, CDTFA, what is the first date of liability that we are looking at?
Let's see. Just a moment.
Sure.
The earliest quarter in which the corporation has a liability is the second quarter of '07. And the appellant is not personally liable for the first quarter of '10 because of the bankruptcy filing. So really, the disputed period is second quarter of '07 through fourth quarter of '09.
Okay. So my issue 1, instead of beginning with July 1st, 2006, should begin with April 1st, 2007. Okay, and everyone's nodding, so I'm taking that is correct. So we have confirmed liability period from April 1st, 2007 through December 31st, 2009 for issue 1. And for issue 3, the issue remains the same, but we're specifying that it's whether adjustments are warranted to the measure of Blue Velvet sales and use tax liabilities for the fourth quarter of 2009. Okay, thank you, everyone. Then I think we have clarified the issues to the extent that is necessary. Everything else is as stated in the pre-hearing conference minutes and orders. And I'll also confirm that we discussed during the pre-hearing conference that for issue 1, in terms of the 4 elements at issue for 6829, we discussed that the element of termination is not in dispute. It's only the remaining 3 elements. And then for the 4th element of willfulness, the prong of whether there were funds available is not in dispute. And I'm just confirming what's in my order already. Okay, then I think I have confirmed the issues. I'll move on to discussing the evidence. Finder. Okay. First, I will discuss that we've received new documents from appellant today. And as I stated during the pre-hearing conference, and as I stated in the minutes and orders, if additional exhibits are submitted after the February 7th, 2020 deadline, such exhibits may not be allowed into the evidence record unless there is a showing of good cause, meaning good cause why they could not have been produced sooner. So, Mr. Brandeis, can you explain why these documents weren't produced previously?
It's possible that they are already in the documentation provided, but there's well over 1,000 pages of documentation. So
I thought
it's
900.
or 920. I'm sorry.
I just wanted to make sure I wasn't missing.
And so, you know, I didn't go through all 920, or at least I didn't go through them in detail one by one. But the documentation that we're providing is a go-back that was written. If you're not familiar with the audit process,
I am.
There's a district reviewer who reviewed the field work of the auditor and wrote an extensive go-back. That document is not necessarily as important. We're just trying to establish the quality of the work done by the auditor. But of much greater importance is that there was a second review. I've never seen this before, but there was a second review done by the district principal auditor, Mr. Albert Lai, and he essentially, I don't know if I would call it a go-back, because he made all the corrections for the auditor. I've never seen that done before, but there were very significant and material corrections made to the general comments and to the 1296 that did not come from the auditor, that contradict what the auditor originally wrote, and were entirely written by the principal auditor, who wasn't there and didn't review any of the source documents. And these comments specifically speak to the issue of tax reimbursement, one of the 4 elements.
But if you can address my question of why you didn't produce these sooner, I issued a
I don't know, it's possible that it's part of the audit working papers. It should have been part of the audit working papers that I know that the department submitted, but I didn't go through to verify that. It's possible that it's not included with the audit working papers, but it should have been part of the audit working papers. Go-backs are part of the audit file.
Well, obviously they produced it to you or your client, or else we wouldn't have it. And I still don't understand, you haven't addressed my question of why you didn't produce it sooner, given that I issued, not only did we have this pre-hearing conference, but I issued a request for a pre-hearing conference statement asking you to identify your exhibits pursuant to the regulations that govern these hearings. So is there some reason why you couldn't produce them?
It's possible that it's in there. If you want, we can take a recess and I can go through the exhibits provided by the department, specifically the audit file, and see if it's in there, and in which case it would be irrelevant or unnecessary to submit it now.
CDTFA, do you want to respond? Do you have any objection to admission of these documents?
We've been trying to figure out whether they're documents that were already submitted or not. We would object if they haven't been submitted already. I don't know. They're documents that are often part of audit work papers, but we haven't been able to confirm that they're in the exhibits.
And I guess I will note, my office puts together the exhibits based on what you indicated. I can never, this is a courtesy copy, so I can never guarantee that we included every single page. We do our best. So I guess the question is, partly what, I don't know if it's something that you possibly submitted to us and previously in the zip file that you provided that I didn't capture in the exhibit binder, but maybe meant to submit it.
On the other hand, I do think that if appellant wants to introduce it, it's kind of should have been incumbent on appellant to indicate where in the exhibits this is before we reach this point. We're prepared to talk about where the evidence we're going to be pointing to is within the submitted exhibits.
I understand. Right. And I will note that I have reviewed, or done my best to review all 900 pages of the exhibits. I don't recall seeing these. I can't guarantee it that I didn't see them, but I don't recall. All right. Mr. Brandeis, do you have any further response?
No, but I do think it's relevant that on the issue of tax reimbursement, that the audit, the general comments in the audit are not produced by the auditor, they're produced by the principal auditor.
All right. I have to mark these as exhibits either way because we have to identify what is included in the record and what is not included. So I will say I will mark these as exhibits 14 and 15, but at this time I am going to say that I'm not going to admit them into evidence because they were produced late, and we have regulations regarding production of evidence. I haven't heard of establishment of good cause for why they weren't produced sooner. However, Mr. Brandeis, you can refer to them in your you can refer to these as in your argument, but it's excuse me. Yeah, they're produced late, and we already have 900 pages of exhibits, and it's not fair to the other party to scramble to respond to late produced evidence. So at this time, I'll say exhibits 14 and 15 are not admitted, and I'll say 14 is the comments in the go-back sheet, and 15 is the account update information. Let's move on to the remainder of the exhibits in the binder. For appellants, exhibits 1 through 13, as I mentioned, exhibit 13 is the one where there's duplicates. Because we received the pages from there was like pages from an email. We received that first, and then separately we received the report of discussion of audit findings, the BOE 836A, and we added them together, but really we didn't need the extra, the first pages from the email, so they're just duplicates. Otherwise, I'll start with appellants exhibits 1 through 13. Does CDTFA have any objection to admission of any of these exhibits? No. Okay. Appellants exhibits 1 through 13 are admitted. And then I'll move on to respondents exhibits A through I. Does appellant have any objection to admission of any of these exhibits?
No.
Okay. Respondents exhibits A through I are admitted. And since we have addressed the issues and admitted the evidence, I think we are ready to proceed with arguments. As we discussed, we begin with taxpayers' arguments. And Mr. Brandeis, I believe we said 30 minutes? Is it?
I don't think we'll need that long, but
Okay.
that's to be margin of safety.
Alright. And then, that's fine. And then, everyone knows that the judges may have questions. And then, next CDTFA presents its argument, and we had an estimate of 45 minutes.
That's correct.
Okay. And then CDTFA may have questions, the judges may have questions of CDTFA. And then, appellant will have an opportunity for rebuttal. We said up to 15 minutes. And the judges may have questions, and then we should be able to conclude. Does anyone have any questions or anything to raise before we begin? Okay, then, Mr. Brandeis, whenever you're ready, please go ahead with your argument.
Thank you. I'd like to begin with a discussion with my client, Mr. Bret Mosher's
Mr.
background.
Mendes, I apologize for interrupting you. Could you please turn on your mic for the video recording purposes? Thank you.
I'd like to begin my presentation with some background on my client, Mr. Mosher. We're going to talk a little bit about his education, his work experience, and how he came into operation of Moxie and Blue Velvet. So first I'm going to get into his education. Mr. Mosher, if you could please describe your education.
All right, and I will note, Mr. Mosher is not a witness. He's not been sworn. There was no identification that there was going to be witness testimony. However, anyone can make argument, and I will consider this as, we the panel will consider Mr. Mosher's statements as part of appellant's argument.
Okay. Yeah, again, Bret Patrick Mosher. Education was Cal State Fullerton. Went to night school there for 5 years to get my degree in marketing, business administration, while I worked simultaneously full time. I graduated from Cal State Fullerton in 1985 and switched careers at that point, went into real estate brokerage. And typically we represent buyers and sellers of small apartment buildings. It was 1985 to 1990. While I was brokering those properties, I would typically try and buy one small duplex or fourplex per year for myself to try and eventually become a real estate developer. And so up until 1990, I had 5 properties. Business was going pretty good for me. And then the Great Recession hit in 1990 until about, oh gosh, probably 96, 97. So I continued brokering properties at that point. I started getting aggressive to buy more properties in the late 90s and built those small apartment buildings and the equity in those up with partners to larger apartment buildings. And so work experience was both in brokering, multifamily, and obviously in investing and adding value to multifamily properties in addition to management. Those properties took me to out-of-state opportunities, both in Minnesota and Kansas. The Los Angeles market only had limited opportunity for me. So at that point, I was traveling quite a bit, and I had 2 large apartment buildings in Kansas and 1 in Minnesota. So I spent all of that energy building things up. Things are going pretty well. Then in early 2000s, I forget the exact date, I saw an opportunity. I saw an old Holiday Inn hotel. It was built in the 60s in downtown Los Angeles. And so with my marketing background, I thought, what a great opportunity to take this unutilized property and turn it into something similar to what the Standard Hotel was in downtown LA. I was very impressed with the changes in downtown Los Angeles at the time. Population was a fraction of what it is currently. But I saw the opportunity there. I saw the good energy that the Standard Hotel was doing there as a hotel and restaurant and lounge, and wanted to take that same energy and utilize it in this property. So sure enough, eventually I was able to acquire the property, purchase it, and renovate all 205 apartments
So it was around this time that you met, we're not gonna use full names for some of the other persons in this, we're just gonna use first names. It's around this time that you met Tom
Yes.
and Robert. Explain how you came to meet them and what their role was in this new venture that you acquired with the Holiday Inn property.
Okay, yeah, I came to meet them because they were employees of that facility.
Standard Hotel.
The Standard Hotel, yeah. Tom was the bar lounge manager, and I think they arguably had 2, potentially 3 bars in that location. And then Robert was, I forget his exact title, but basically he was in charge of all of the food with a good culinary background, educated at Culinary Institute, and prior to that, graduate of Pepperdine University. So good background, and Tom had a great background on some other things I won't go into detail on. So I basically befriended these guys a little bit. So they, ever thought of doing some opportunities and partnering up on another property, and I explained the location, et cetera, et cetera. And so that was the origination of our relationship with these entities.
So did you enter into an informal partnership agreement with Tom and Robert, and if you could describe that?
Yes, I did. The informal partnership was, my role was actually to be preferred as the investor. My background is in real estate development and real estate brokerage. As far as hospitality business, that's not what I do. Not my area of expertise, but that's, these guys did it successfully. I saw that, and I wanted to present an opportunity for these two guys to turn in and actually add value to a restaurant location that was phenomenal. So anyway, they both thought it was a great opportunity. Tom continued to maintain his current position while we were doing the build out of Blue Velvet Restaurant, and he sent Robert over to oversee the build out of the restaurant location. And the plan was, once that restaurant location was built up, then Tom would come over and join in as a partner. And again, a partnership agreement is supposed to be an earn-in. I put a lot of money up, and that's my job. Put a lot of money up, for the build out of the restaurant and to fund operations. And their job was to do their respective roles in their area of expertise. Tom,
What were those roles? What was Robert's role and what was Tom's role?
Robert's role was oversee all of the bookkeeping, management, forte in the food side, and then Tom's role, he's a phenomenal background in basically bar lounge management. Again, I can go into his resume, but some of the top bars and lounges in Los Angeles, he had a great reputation. So, and he had the clientele to bring in. So that's he stayed on board a couple months after opening, and then the person that he worked for did not want to lose him. So he came out and had a meeting with him and just pulled him back into his respective role. So later on, he did not become a partner, and Robert, it's supposed to be Robert, managing the entire operation, and then myself strictly as the investor side.
Did Robert contribute funds to the construction and build out of Blue Velvet?
Yes, he did. If memory serves, approximately $100,000 to $150,000 before the operation opened up.
Okay, so Robert's role, once operations, he kept you appraised of what was going on during construction, during build out. During that time, you were running your business empire in Minnesota and Kansas. You don't have an accounting background. You're not an auditor. You sort of trusted them and relied on them and the information that they gave you. And that relationship continued into when construction was completed and you began actual operations. Is that correct?
That is correct and accurate.
Okay. So who did the accounting at Blue Velvet and Moxie? Whose role was that?
Martha.
And who hired Martha?
Robert.
Okay. And where did they work? Where were their offices?
Their offices were on site behind the restaurant. One was one of the small.
So their offices were at 750 South Garland?
Correct.
And did you have another office in Los Angeles? And if so, where was that?
Yes, I did. and that was over at 1425 West 7th Street.
Okay, so they sort of did their thing in working over at the restaurant in South Garland, and you managed your other business entities from 1425 7th Street in Los Angeles.
Correct.
How often did they update you on the operations, and how often did you have physical meetings?
Update via email. Again, I was out of state mostly at that time, but via email a couple times a week perhaps. When I was back in town, we tried to get together for a meeting, maybe once a month, twice a month, and try to give my input as best I could, not being in the business, but just be there for support.
Who applied for the seller's permit?
I know that Robert would have been procuring that, but I don't remember who signed on that.
Okay, so we have, it's part of the dual package. The seller's permit application was submitted, and it was signed by both Robert H. and my client, Bret Mosher. Who filed the sales and use tax returns during the time that Robert was there? Robert.
That would be the responsibility of Robert and Martha.
Okay, and again, as part of the dual package, there's copies of the returns that were submitted. And during the time that Robert was there, when did Robert leave? When did you and Robert part ways?
I wish I could tell you the exact date. More than a decade ago, I can't remember.
Okay, the evidence shows that Robert parted ways on February 10th, February 10th, 2008. So during that period of time, prior to Robert's departure, all the returns, sales tax returns, are signed by Robert. I know that there's dozens upon dozens of emails where they're updating you on the financial results, but in any one of those emails, did Robert indicate to you that they were underreporting the sales tax liability?
No.
So you basically were being informed of the operations, but you had no knowledge that sales taxes were being underreported?
That's correct.
Did Robert have signing authority on your bank account?
Yes, he did.
Did Robert have, who processed payroll and had authority to process payroll?
Robert.
Okay. So I'm going to move this, we sort of want to lay the groundwork for what the history leading up to the development, the relationship between my client and Robert H. Robert H. was, as far as we know, he was also dual as a responsible person. The exact period of time we're not 100% sure, but I would assume that was up to his departure date. Mr. Harstead, Robert H., he was the person that had operational knowledge and financial control. He hired the bookkeeper. He signed the returns. He filled out the sales tax application. He listed his name as an officer under the sales and use tax application. And if we look at section 6829, there are 4 elements that are necessary in order to dual somebody as a responsible person. As we've already indicated, we're not going to dispute the issue of termination. But 6829 subsection B states in part that a member, manager, partner, or other person shall be liable only for taxes that became due during the period that he or she had control, supervision, responsibility, or duty to act. And if you look at the CPPM, section 764.080, under responsible persons, it says, additionally, the responsible person shall be liable only for transactions where the taxes became due during the periods he or she had control, supervision, responsibility. That is, from the opening date until until the fourth quarter 07 return was filed, that responsibility vested with Robert H. My client, although he is being informed of financial results via email, he had no knowledge of underreporting. He had no knowledge. He only knows what they're telling him. And he is spending the bulk of his time and efforts and energy in running his businesses in Minnesota and Kansas. And also those operations in Los Angeles, his real estate development business in Los Angeles. He is totally reliant on Robert and the bookkeeper to keep him informed. There's not one email that informs him of underreporting, and there's not one email asking for his authority to act. All of those vested with Mr. Harstad, who is in effect a de facto partner in this informal partnership. Talk about the second element, sales tax reimbursement. In order to hold somebody responsible as a responsible person, the department has to establish that during the period of liability that the entity collected sales tax reimbursement. Now, just sort of to remind folks here, Civil Code Section 1656.1 creates the presumption under which we can presume that parties have agreed to sales tax reimbursement. Those presumptions are stated, there's 3 of them, that an agreement of sale expressly provides for such addition, such as a contract. Well, there's no contracts. You know, the customer comes in to buy dinner, there's not a contract signed, so that one's not really relevant. The second is sales tax reimbursement is shown on the sales check or other proof of sale. The auditor spent 517 hours. Let me say that again. 517 hours on this case. He says that he had bank statements, he had P&L statements, he had financials, he had the sales tickets. He doesn't make one photocopy of a receipt showing tax reimbursement. Not one. Form 1296, which is part of the audit working papers. And if you read the audit manual in section let me find it here. Well, if you read the audit manual, it talks about Form 1296, and it states in there that you are required to fill out that form. You're required to note on the form whether tax reimbursement is added to the retail selling price of property sold, and you're supposed to include a copy of a document, a sample document that supports that. Not some 517 hours spent on this case. He photocopied bank statements and he photocopied P&Ls. He didn't photocopy one receipt, not one. The other area of the audit that you would note sales tax reimbursement is in the general comments. His general comments are literally all over the place. He has changed the general comments probably 5 or 6 times. He has, I'm going to read them. This should all be part of the audit working paper. His general comments are part of the audit workbook. Under source of data, he says federal income tax returns for 2006, 2007, profit and loss statements for 2007.
Can you slow down, please?
Federal income tax returns for 2006 and 2007, profit and loss statements for 2007, 2008, and the first half of 2009, purchase and sales invoices for the same period above, and then somebody who hand writes in number 4, sales tickets. Under tax reimbursement, this is where.
Let me ask, can you point me to where in the exhibits you're reading from?
It's from the general comments.
Right.
Should be part of the audit workbook.
I'm just looking for a page number.
I don't have a page number in front of me.
Okay.
But it's the general comments.
Oh, okay, hold on.
There's about 4 or 5 different dates, and the comments are constantly changing.
Are these the comments on the Form 14E, 414E?
These would be the comments that end up. Well, this version is in an Excel workbook. This is what the auditor types in to enter the general comments. The general comments are then eventually uploaded into the IRIS system and look like this, which I think is what you refer to, the 414E.
All right, go ahead.
So the comments change from this is comments from 2010. He says, under tax reimbursement, sales tickets and other records reviewed showed sales tax included, but those were not given consideration by taxpayer in determining taxable total sales. I don't even know what that means. Then on the same date, the comments change under the same heading. No sales tax reimbursement was included in determining taxable sales. Then on November 22nd, 2010, again, general audit comments, books and records, double entry set of books and records supported by books of original entry adequate for sales and use tax. Sales tax reimbursement was not included in the sales tax returns. You know, the audit manual gives guidance on what the general comments should say, what you should be addressing. In chapter 4 of the audit manual, which I'm having trouble finding that section. Well, let me pull it up online.
If you know what you're going to refer to, you don't have to give me the section number. I can pull it out.
Okay, I just, give me one moment. It's chapter 4, general audit procedures. I'm sorry, chapter 2, preparation of field audit reports. Section 0206.36, under books and records. There's 6 things listed in that AM section, and he doesn't address any of them. Number 4 is whether sales tax reimbursement is included or added in the selling prices of items sold. That, along with the 1296, which is required to be completed, section 0201.20 of chapter 2, auditors must complete form CDTFA 1296. And it states in there about 2/3 down, detailed completion of form CDTFA 1296 can assist in determining a responsible person liability when needed. As soon as form 1296 is completed, a copy of it, comma, along with proof of tax reimbursement and any documents used to verify changes in corporate officers should be routed to the district principal compliance supervisor. Wasn't done. 1290, Chapter 2, 0201.20, it states under, again, this is under Form 1296, that they should, examples of taxpayer records illustrating that taxpayer included or added sales tax reimbursement include copies of sales receipts, register receipts, point of sale documentation, and it says examples must be included with Form 1296. It wasn't done. It wasn't done. In fact, the comments written in the general comments, which is part of the exhibit that I submitted today, those general comments were written by the principal auditor. Why did he write them? Well, if you look at these go-backs he's getting, I mean, he's getting 4 or 5 page go-backs, paid top to bottom, of issues with his audit. They were under a statute deadline. There was no more time to let him muddle around and fix this thing. So the principal auditor just wrote his comments. That is what I submitted to you earlier. And I'd like to read you what Mr. Lai says. Books and records comment. When you have to disregard the recorded sales and estimate the sales using bank deposits and markup methods.
Please have you slow down when you're reading.
I'm sorry. When you have to disregard the recorded sales and estimate the sales using bank deposits and markup methods, the books and records are inadequate. Do not say it is inadequate for a full audit, but enough to estimate sales and use tax. Also, we are interested in whether sales tax reimbursement is added or included in the selling price, because in order to dual determine the corporate office, it is required that the business collected sales tax reimbursement. You comment that sales tax deduction is not taken on the sales tax return is not the correct comment, because the business can deduct sales tax reimbursement but does not deduct sales tax included, because you reported total sales on line 1 is already X tax. I modified the comment for you. Under the 1296, is Albert Lai's comment. I modified your comments regarding sales tax reimbursement. These aren't the auditor's comments. The auditor's comments were that books and records were adequate. He examined sales receipts. He makes a comment about there's no sales tax included in gross receipts, but these comments are written, the comments that you see in the final version of the audit are written by the DPA. He wasn't there, and he didn't examine any of the records. This is, in a court of law, this would be like planting evidence. So what evidence does the department have that sales tax reimbursement was added to the retail selling price? The only thing that I could see that they have is comments in a questionnaire filled out by the bookkeeper, who, by the way, it was terrible at her job. The reporting, I look at the transcripts, the transcripts to me are so, the reporting is so bad that it's grossly obvious that underreporting was occurring. At whose direction that was happening, I don't know. I wasn't there. Mr. Mosher is only relying on the information that he's being fed by the bookkeeper and Robert H. But this is incompetence or potentially intentional fraud. It's that bad. It's that bad. But it certainly wasn't at the direction of my client. It certainly wasn't with his knowledge that this was happening. The department may point out that, well, there was internal worksheets that showed sales tax. We don't dispute that, but that's not evidence of tax reimbursement. Sales tax on an internal worksheet could be calculated without tax reimbursement. I'll give you an example. Let's say you had invoices totaling $1 million, and the invoices had no tax reimbursement and had no indication on the invoices that tax was included in the retail selling price. And now let's say that same taxpayer reported that $1 million in gross receipts as sales tax included. And if an auditor were to examine that and see that there was no tax reimbursement or notation stating that tax reimbursement is included in the retail selling price, or any other document such as a contract stating that tax is included, there's no way that the auditor would allow the taxpayer to report tax included. They would require them to report X tax. And the presumptions created under Civil Code 1656.1 would be their basis for that. The items laid out in that Civil Code create the presumption of tax reimbursement. They don't exist here. There's no receipts. There's no documentation. The auditor doesn't even comment what kind of a cash register system they use. Do they use a point of sale, electronic? The incompetence here is off the charts. That's why he got a go back that is 4 or 5 pages long, and the principal auditor had to fix everything for him and even planted some evidence. On the issue of responsible person liability, this is one of the elements. I believe that there can only be one responsible person at a given period of time. The responsibility to file and pay sales taxes, which is what the law section and states is used. They're trying to go after the spirit of the law. The legislature's intent is to go after the person who had the responsibility for filing and paying the taxes. That person from opening day through fourth quarter 2007 was Robert H. and Robert H. alone. If you read the CPPM, if you read the audit manual, if you read the law sections, they have to make a determination who's responsible at each period in the audit, because that responsibility can change. I would argue after that, my client had to take more of an involvement. He did hire another manager to replace Robert. My client did not, treated that second manager in the same sort of fashion as Robert. He sort of left him to manage the restaurant. And then there was as the Great Recession really started to kick in, there was quite a bit of turnover. If you read the comments by the auditor, there was a number of turnover in staff until he hired, I don't know the name of the company, but he hired a specialized restaurant bookkeeping firm. And again, if you look at the transcripts, you can see in the last 2 periods of the audit, the reporting improves dramatically. Well, that's when he finally got rid of all these restaurant managers who really didn't know what they were doing. By the way, the bookkeeper hired by Mr. Harstad, she continued to stay on with the company and process the filing of the returns up until her departure, we believe in sometime in late '09.
That's not right. It's Martha.
Martha, yes. So the person whose gross incompetence during the period of time that the returns were filed, you can see that there's no way that, so in some periods they're reporting quarterly sales of $5,000 a month. There's just no way. It would not take a genius auditor to figure out there's a problem here. But she is involved in the bookkeeping, and between her and Robert, they're both involved in filing the returns. Some returns are signed by Robert, some returns are signed by Martha. The issue of willfulness, Mr. Mosher, as far as I can tell, had no knowledge of underreporting until, and I'm looking at the 414Z, which is the assignment activity history, entry dated December 31st, 2009 by the auditor. It says, at the business on 12/39/2009, met with owner and bookkeeper Janice, explained in details the schedules I had. The schedules included bank statements. The owner was surprised to see that whoever did his books and records was likely not reporting one location to BOE. He said he had a full-time bookkeeper. This is the date that the first evidence I can find where he has become aware of what's going on, that the potential for significant underreporting. Prior to that, he had no knowledge. He had other businesses that he was running. He's in Montana, Minnesota, he's in Kansas, he's a real estate developer, he's not a restaurateur, he's not an accountant, he's not a bookkeeper, he's not an auditor. And I don't believe that you could take that knowledge and make it retroactive to satisfy the responsible person portion. He did not, he succeeded the supervision and control to Robert H., at least through the end of '07. Final note, as part of the dual package, Exhibit 1, page 1 of 2, is an ACMS note from a collector for a phone call made to Robert H. on June 17th, 2013. I'm going to read to you what the collector noted in those ACMS notes. I received a call from Robert H. He was the original GM for the company from 2006 to early 2008 and was listed as such on the seller's permit application. He stated that Blue Velvet was a single member LLC and Bret Mosher was the sole member, owner, and investor. Harstein stated that he helped Mosher set up the company and get all the permits. He stated he was a paid employee that was responsible for the day-to-day operations. He had signing authority on the bank account and was responsible to ensure sales taxes were filed and paid. This is the board's employee noting the details of the phone call with Robert H. I'd also like to note Robert H. was, and we believe was dueled during this process. He wrote a statement, also dated, actually dated the previous day, June 16th, 2013. I'm not going to read you the whole thing. It should be part of the dual package. Second paragraph, I was an employee of Blue Velvet LLC. Blue Velvet LLC had an entity number, blah, 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 and was a single member LLC filed by Bret Mosher in February 2005. I was not a member nor manager of Blue Velvet LLC. I mean, my gosh, he's not even a manager? I mean, this is a lie. He's on the bank account. He files the sales tax returns. He is operationally and financially in control of this business unit. But why does he say that? Because he's been given a letter from the Board of Equalization at that time indicating that they are going after him for personal liability for $813,000. So yeah, he's scared. I would be. And sometimes when people are frightened like that, I would be terribly frightened. They might say things that aren't true. And with that, I'm going to turn over my time to the department.
Okay. And you will have additional time on rebuttal.
Thank you.
Okay. You can go ahead and some of your questions.
I have some questions for you, Mr. Brandeis. I'm a little confused when you were making your argument. You had mentioned the applicability of Civil Code Section 1656.1. I believe that pertains to when the department can establish that sales tax was included in the selling price of property, but not necessarily as to whether tax reimbursement has been collected. For example, you could have a situation where tax was not included in the selling price. I sell you a bottle of water, for example, but the tax is not included in the sale price of that water bottle. Yet, tax could still be collected on that sale. So I'm wondering, is your argument here that all the sales were made with tax included in the sale price and that the measure should be reduced accordingly, or are you simply stating that tax has not been collected at all?
I'm stating if I could read to you, this is out of the Field Audit Manual, section 0801.45. Under sales tax included. It says, certain presumptions concerning the addition of sales tax reimbursement are created by Civil Code section 1656.1. It shall be presumed that the parties agree to the addition of sales tax reimbursement to the sales price of tangible personal property sold at retail to a purchaser if, there's three things listed here. Number one, the agreement of sale expressly provides for such addition of sales tax reimbursement. Number two, sales tax reimbursement is shown on the sales check or other proof of sale. Or, number three, the retailer posts in his or her premises in a location visible to purchaser or includes on a price tag or in an advertisement or other printed material directed to purchasers a notice to the effect that reimbursement for sales tax will be added to the sales price of all items or certain items, whichever is applicable. Without one of those three, you cannot presume that a seller has collected sales tax reimbursement. Without one of those three, it is presumed there is no sales tax reimbursement. So who has the burden of proof here when it comes to responsible person liability? The board. The board has the burden of proving the facts, and they didn't do that here. There's no receipts showing tax reimbursement. Go down the list. There's no receipts showing tax reimbursement. 517 hours on this audit. He was there with the sales receipts. He didn't photocopy one of them. All he had to do was photocopy a few receipts to show, as document as evidence, are they collecting sales tax reimbursement? His general comments, he doesn't address it. He says books and records are adequate. The DPA completely changes his general comments, who, I might add, wasn't there and never looked at the source documents. So, burden of proof is on the board. Auditor did not document it. There's three things that he could have looked for. The first one doesn't really apply because as agreement of sale, usually a contract, somewhere in a contract you might have a clause that says we are adding sales tax reimbursement. We're talking about a restaurant. They don't have contracts. They have receipts. He didn't get it. There's not one. And the presumption, this is what is required to establish that presumption of tax reimbursement. It's not there.
I understand what you're stating, what you're arguing regarding the collection of reimbursement, but based on what you just read to me, it sounds like that statute pertains to the addition of sales tax to the selling price, not the collection of the tax reimbursement itself. Is there any argument that sales tax was in fact added to the selling price, whether or not it was collected?
I wasn't there. I met Mr. Herstad in 2013. I've never looked at, other than bank statements and the P&L statements that we got from the department, I've never seen a sales receipt. They had a point of sale system. I believe you mentioned Aloha. There's no data. There's no receipts out of the system. I've never seen one document that shows tax reimbursement, a sales receipt. I haven't seen a menu. I haven't seen a price list, signage, nothing. And without that, you cannot presume tax reimbursement.
Okay, I might ask Mr. Mosher, were you aware of, I guess, the billing practices of Blue Velvet in this case? Were the menu items listed merely without tax included in those prices?
I don't remember.
You don't?
Yeah, it's not my area of expertise.
Okay,
Yes,
thank
sir.
you.
Yeah.
I noticed also in the pre-hearing conference minutes and orders that there had been an issue raised. I think it was also raised in your opening brief regarding the application of payments. Is that still at issue here?
I don't like the way that the department has applied payments, and I don't agree with the way that they've applied the payments. When I'm a former auditor myself, and one of my first roles when I was hired as an auditor, they put me in charge of something they call the spot check review of fiscal controls. Now, what that means is it was my job to audit compliance and to review, make sure that they were following board policies and procedures with respect to their duties. And most of that involved the collection of payments. As part of that training, we reviewed how payments were applied, accepted and applied by collectors. And as part of that training, and it's always been my understanding that tax is applied, there's a hierarchy. And it also has to do with the way the board calculates interest. The board only calculates interest on outstanding tax. They don't do like what banks do. They don't calculate interest on outstanding penalty, and they don't calculate interest on outstanding interest. So it would be beneficial, as a general rule, payments were applied in the manner that was most beneficial to the taxpayer. So that meant applying the payments in their entirety to outstanding tax first. Once outstanding tax liabilities were paid, then remaining payments would be applied to interest and penalty accordingly. That would be the most beneficial way to apply a payment to a taxpayer. And here, they're saying, well, we didn't get direction on how. So they applied the payments, part of it to tax, but part of it to interest and penalty. That goes against everything that I know in the way that I was trained when I was a fiscal reviewer back in 1999.
You had cited something I thought that was seemed to be on point. The CPPM
Yes, so
707.020. I'd like to read from a portion of that because I feel that perhaps I'm missing something here. It states that at the very end of that section, there's no ability to direct the payment specifically to the tax, interest, penalty portion of the liability. It also mentions that payments received from warrants can only be applied to the specific periods covered by the warrant.
I'm sorry, what section is that?
It is 707.020.
Okay, I'm there.
Okay. It would be the final two sentences of that section.
.20.
Yes.
The heading I see for that section is where no adjustment made to original audit findings.
It should say payment application rules. 707.02.
Okay, I'm looking at, the version I'm looking at is online. I don't, there's been changes to,
Okay, I
but
understand.
that section does not exist on the CDTFA's website. But that said, let me see if I can find it. What's the heading title of that section?
Payment application rules, I believe. Yes.
Oh, I'm sorry. I was looking at the audit manual, not the CPP. 707. Payment application rules, okay.
So if you look at the, I don't know how to describe it, but I would say the first page of that section at the very bottom, the last sentence, however, there's no ability to direct the payment specifically to the tax, interest, penalty, or collection cost recovery fee portion of the liability. That would be the first part. And then if you go to the following page, again, the last sentence, and I don't know if this would be applicable here, but payments received from warrants can only be applied to the specific periods covered by the warrant.
Okay, so even if it's applied to a period covered by the warrant, it would have to cover the tax portion in full first, before it's applied to any interest or penalty.
And are you saying that's not what occurred here?
I don't have that, which payment are we talking about?
I'm trying to understand which payment you're saying was not applied correctly and where.
Well, there was a payment for the sale of the liquor license And there was
I believe a claim paid in bankruptcy as well.
there was a claim paid in bankruptcy. But the bankruptcy, I'm not a bankruptcy attorney, but the bankruptcy filing, I believe they would have noted on the bankruptcy filing the period for which the BOE CDTFA was a creditor, and if there was amounts paid, I would imagine it would go to that period. It would identify the period that the BOE/CDTFA was a creditor, and again, it should have been applied to tax first.
And are you saying for those periods that were paid, these liability periods that were paid, the amounts were not paid towards the tax first? And that there's still outstanding amounts of tax on those periods?
If you have $2,000 in outstanding tax for a particular period, in a $1,700 payment comes in, the entirety of that $1,700 payment should be applied to the tax. Not one penny of it should be allocated to interest or penalty for the period of liability that exists.
Okay.
It's always been a general rule that payments are applied in a manner most beneficial to the taxpayer.
I believe from what I understood from reading your brief was that the tax was, the payments were applied to the tax first, but that also the interest and penalties for any given liability were also paid before applying additional payments to other liability periods.
And that's my point, it shouldn't be. It should be only applied to tax. And when outstanding tax liability is fully exhausted, then payments should be applied to interest and or penalty.
Okay, my question then, therefore, is looking at this section, where in this section would support the application of payments as you've just stated?
Number one, it's directed by the taxpayer at the time of voluntary payment. Now, again, a payment was made by the bankruptcy court. I don't know what instructions came with that, but generally speaking, again, sometimes payments come in and it's not indicated how the payment is to be applied. And when that's the case, it goes to the oldest outstanding period first and it applies to tax. Then it goes to the next outstanding period and applies to tax. And until it's exhausted. If it's not exhausted, if all the tax is paid, then it would go to satisfying outstanding interest or penalty.
Let me chime in for a second. So are you arguing that payments by a bankruptcy trustee are voluntary payments?
I don't know how the law defines a voluntary payment. I don't know. I don't know how to answer that.
And the same question about the liquor license payment.
When the liquor license, do you recall how the liquor license sale was transpired? Did that happen through bankruptcy or was that before bankruptcy?
I don't remember.
Perhaps ask CDTFA, was the liquor license sold by CDTFA or was this sold on the LLC sell the license and then remit the funds?
It was sold through it's complicated, but it was during the bankruptcy pending that it was sold, and I'll address that in my.
Thank you. I just have one final question. I also noticed that you had raised an issue pertaining to Blue Velvet's audit liability for the fourth quarter of 2009.
Yes.
Yes, and I realized that this was a policy that the board had, a practice the board had allowed for many years, that to allow in these type of 6829 personal liability cases, allowing the taxpayer to essentially contest the underlying entity liability. One thing that I didn't quite understand is I wasn't able to find any authority that would allow a body like us to adjust what's in essence a final liability, since this, if we were to find the taxpayer in this instance was a responsible person, you would have had the opportunity to have contested essentially Blue Velvet's liability when Blue Velvet was issued the NOD for these varying periods for which you're now being held personally liable. At this point, what would be the impetus or the authority to allow us to then now adjust what is essentially a final liability against Blue Velvet?
Under the rules for tax appeals, the OTA rules for tax appeals, I gotta look them up because I don't have them memorized. We had this discussion, if you recall, Ms. Brown, over the phone about whether or not the agency had the authority to hear a case involving the movement of payments and whatnot, and I said that affects interest and therefore affects the liability. And you cited a section, and we responded. Can you remind me what?
I think you mean regulation, I think it's 30420 is the one you're referring to.
Let me look
But,
at
but that's just the provision that limits our jurisdiction.
Right. So isn't that your question, whether you have the jurisdiction?
Correct.
Okay, so what was that,
30420, but I'm doing that from memory, so if I'm wrong, somebody correct.
Okay,
3103?
That's the one that we have we have
Or for
jurisdiction.
limitations,
Oh.
3104?
Yeah, sorry, I was wrong, 30104.
and I believe that's for FTB.
Oh, okay.
No, CDTFA as well, provisions.
Oh, right, 30420 is, evidence and witnesses, sorry.
So 30104, 30104.
Well, that was the one that I had cited, the limitations on jurisdiction. The one that actually provides our jurisdiction is the previous regulation 30103.
Subsection B, subsection little b.
Yes.
I don't
Okay.
believe that my question implicates 30104. I'm merely speaking as to the finality of a tax assessment against Blue Velvet.
If you give me a second, let me.
Sure.
Okay, so 30103, little b, says, under appeals from CDTFA, in general, OTA has jurisdiction to hear and decide an appeal that has been timely submitted pursuant to these regulations if any of the following circumstances apply. An appeals bureau decision is adverse to the taxpayer in whole or in part. The local entity, I'll skip that, the state agency, so we argued at the Appeals Bureau about the issue of the application of payments, and the decision was adverse. So right there, that is the impetus for the jurisdiction for this body to hear the case, and it does affect the amount of liability of the taxpayer. The liability is overstated. Why? Because they're applying payments to interest and penalty instead of applying to tax, which would reduce the overall interest calculation. So under that subsection, I believe this body has the appropriate jurisdiction to hear the matter.
I'm sorry for any confusion. I was speaking as to the audit issue you had raised in your briefing concerning the fourth quarter of 2009. And I believe also first quarter 10, which is now.
That generated the underlying audit liability?
Correct.
Well, again, my client received a notice of determination for personal liability that is overstated. It's overstated because the audit was overstated. And we had a huge adjustment at the Appeals Bureau level because of the way that the underlying audit was performed. We received a huge adjustment. The adjustment that they made didn't go far enough. And as a result, the liability against my client is still overstated. So we filed a timely and valid petition. His NOD is overstated because the underlying audit that created it is overstated. And we have a right to appeal that. We've now received an adverse opinion from the department in the form of a decision, and OTA has the jurisdiction to hear that.
Mr. Mosher, is there a reason that when Blue Velvet received the NOD for that period of time that the LLC itself did not appeal that?
Again, I've been relying on my professionals. I'm a marketing guy, I don't understand this forum, and so I refer to
If
my
I could,
professional.
if I
Sure,
can.
go ahead.
So, once, again, if you go to the 414Z, I mentioned the date that Mr. Mosher became aware that there was significant underreporting. That was in end of December 2009. He hired a gentleman by the name of Kai Mickey, who is, like myself, a former BOE auditor and a sales tax specialist. And Mr. Mickey represented him in the audit portion, during the field audit portion. Now, I believe Mr. Kai Mickey passed away. I don't know.
He did not.
He did not? Oh, okay.
He's fine.
The rumors of his demise that are premature. Okay, I don't know why, but he was the original representative. I apologize, Mr. Hynek, if you're out there. He was the original representative. Why he did not file a timely petition, I don't know.
Okay, thank you, I don't have further questions.
Apparently, he was alive and well to do something.
I saw him a few weeks ago, so it's fine.
No questions.
I think I'm thinking of Abe Galone.
Yes, yes. I'll have just a couple questions, one or two questions now, and then I will probably have more afterwards. I guess I just want to ask about this collection of sales tax reimbursement issue. It seems remarkable to me that there would be a restaurant in Los Angeles that was not collecting sales tax reimbursement or adding sales tax reimbursement. Wouldn't that be
Unusual?
highly unusual? Yes.
I don't go to Starbucks as much as I used to, but I've never been to a Starbucks in California that charges sales tax. Never. Well, I mean, I guess technically they do. They usually have the signage somewhere if you search for it. Because I'm a sales tax person, sometimes I look for it. Sometimes I see it, sometimes I don't. But I've never been to a Starbucks that charges sales tax. So they had a cafe, Moxie Cafe. What's their sales tax? Remember, I met Mr. Mosher in 2003. I wasn't there. The only records I've seen are what records I've been provided by the department. The records are gone. This is 2006 to 2010. But you can't presume sales tax reimbursement. The law doesn't permit it. The addition of sales tax, the presumption for the addition of sales tax is created in that civil code section I cited. And so without that evidence, you cannot presume sales tax reimbursement. You just can't do it. Listen, the example I gave earlier about a gentleman or a business that has $1 million in sales, no sales tax reimbursement, no documentation or notation to the customer that is included in the selling price, nothing in a sale contract. If they tried to take a sales tax included deduction on that $1 million, they'd be called out on that in an audit. Why? Because they don't have the presumptions documented in 1656.1. You have to have those.
So are you arguing that 1656.1 is the sole and exclusive measure, where the sole and exclusive tool by which we can evaluate whether sales tax reimbursement was collected?
You have Regulation 1700.
And 1700, but
okay, but the regulations are the board's interpretation of the law. The law is controlling, and the law says that in order to presume that the parties have agreed to the reimbursement of sales tax, these are the three elements that must be present. And they haven't done it. They haven't documented it.
But you're saying that those are the only, we can't look at other evidence?
No, I'm not saying you can't. You can look at other evidence, but the other evidence that I've seen cited by the department, such as internal worksheets, emails to Mr. Mosher saying that this was our sales and this was tax, that doesn't prove that that tax was reimbursement was added to the retail selling price. It only shows that they made a calculation for tax, but that could have been an internal calculation that doesn't meet the requirements under 1656.1.
And then going back to my original question about wouldn't it be unusual, you cited the example of a coffee shop, but for a restaurant, wouldn't the customers be commenting that there's no sales tax, what's going on, how do I calculate my tip, because
Well, there's
normally I
no-
double the tax?
There's no law in California that says you have to charge sales tax.
Right.
The sales tax reimbursement is contracted between the retailer and the seller. Would it be unusual? Yes, but it's certainly not illegal. And so the 6829 and 1702.5 make it very clear. The board has the burden of establishing the facts. They have the burden of proof. So what do they have? They don't have copies of any receipts. They don't have signage, no picture of a signage. They don't have copies of any receipts. They don't have signage. They don't even have appropriate audit comments, unless you consider the comments written by the DPA, who wasn't there to be appropriate comments. All they have is a questionnaire filled out by Martha Wiener, indicating that tax reimbursement was added. But that's it. Is that strong enough evidence? You gotta ignore all the if you read actually the CPPM under dual determinations, chapter 7. This is section 764.130. They list, this is a guideline for the compliance department to document sales tax reimbursement for the purpose of a section 6829 dual. The important ones they put in bold. So I'll go over them. The first one, which is not in bold, ACMS notes for statements by officers, members, partners, employees. I don't know if there's any ACMS notes that state that, and by whom.
In the interest of time, just tell me again, what section are you citing?
This is CPPM section 764.130. Title of that section is Establishing the Elements of an RTC section 6829 dual determination dash sales tax reimbursement and use tax liability.
Okay, I understand that your argument is pointing to the CPPM. I was just trying to say we don't need, I don't need you to read it
Okay,
into the record.
but I'm just to summarize, I've gone down this list and I'm looking at all the bolds here. And I put a yes or no. Do they have evidence of this or not? And the answer is no down the board. They don't have the evidence. The best that they've got is a questionnaire by the bookkeeper. I don't consider internal documents to be sufficient proof of tax reimbursement. The general audit comments the original general audit comments written by the auditor don't support it. He was out there with the receipts. He didn't photocopy one. It's $12.96. Those comments are written by the principal auditor. And it even says it's a requirement in the audit manual. Attach a sample. What document shows that they're adding sales tax reimbursement? Attach a sample. Why didn't he do that? He was out there. He was there. I wasn't. Mr. Mosher's not an accountant, not a CPA, not an auditor. The guy who spent 517 hours on this case was out there with the records. Why didn't he make some photocopies of receipts showing that the additional tax reimbursement? That would have created the presumption under 1656.1.
Okay, thank you. And if we are ready, everyone's ready, we can move on to hearing CDTFA's presentation. Ms. Jacobs, you have 45 minutes. If you are ready, you can proceed.
Thank you. As you're aware, 4 elements must be met for personal liability to attach under section 6829 of the Revenue and Taxation Code. First, the corporation must be terminated. Second, the corporation must have collected sales tax reimbursement. Third, the person must have been responsible for the payment of sales and use tax. And fourth, the person's failure to pay must have been willful. In this case, as was stated in the pre-hearing conference, and today there's no dispute as to the first element. Both parties agreed that Blue Velvet closed in September 2010. As to the second element, there's ample evidence that Blue Velvet collected sales tax reimbursement. Personal liability can be imposed only to the extent that Blue Velvet collected sales tax reimbursement on its sale of tangible personal property in the state, but failed to remit the tax to the department when due, consumed tangible personal property and did not pay the tax when due, or collected or issued a receipt for the use tax but failed to remit the tax. We have copies of Blue Velvet's own daily financial reports for December 1st through December 27th, 2007, which indicate that it collected sales tax reimbursement. These reports show Blue Velvet's revenue by type, have a separate line item for the sales tax reimbursement, and contain an accounting of all cash received and credit cards processed by Blue Velvet. That's in Exhibit A, pages 40 through 66. Collection of sales tax reimbursement was confirmed by former employees, including Blue Velvet's former general manager, Mr. Hartstein, and bookkeeper, Martha Winner. I'm not sure how to pronounce her last name. Comments in the audit working papers also recorded that sales tax reimbursement had been added to the that's Exhibit A, pages 31 through 37. Comments in the audit working papers also record that sales tax reimbursement had been added to the selling price of food and included the sales of bar drinks, Exhibit C, page 77. Appellant has argued that the presumption in Sales and Use Tax Regulation 1700A2 is relevant in this matter. 1700A2 speaks directly to whether a retailer and purchaser agreed to the addition of sales tax reimbursement in the sales price, which is not at issue here. And while the circumstances described in Regulation 1700 would, by default, establish that Blue Velvet collected sales tax reimbursement, meeting a presumption is not a requirement. When there is other evidence of collection of sales tax reimbursement, as there is in this case in the form of Blue Velvet's own records, corroborated by statements by former employees, the department has clearly met its standard of proof, which is more likely than not Blue Velvet collected sales tax reimbursement. We also note that appellant is not denying that Blue Velvet collected sales tax reimbursement, but relying on this false understanding of the presumption of Regulation 1700. As to this third element, it is clear appellant was a person responsible for handling Blue Velvet's sales and use tax matters throughout the liability period. A responsible person is any person having control or supervision of, or who is charged with the responsibility for, the filing of returns or the payment of tax, or who had a duty to act for the corporation in complying with any provision of sales and use tax law when the taxes became due. Appellant was the owner, sole corporate officer, managing member, and tax matters member of Blue Velvet from its genesis in 2006 through the close of business operations. Direct evidence that appellant was responsible for Blue Velvet's sales and use tax matters include his signature on Forms BOE 122, which are waivers of limitation, in 2009 and 2010. That's Exhibit A, pages 93 through 95. Meetings with the department regarding the audit, Exhibit A, pages 116 to 117, and Blue Velvet's own operating agreement signed by appellant, which specifically identifies appellant as Blue Velvet's, quote, tax matters member, end quote, and authorizes him to represent Blue Velvet in all examinations by taxing authorities. That's Exhibit A, page 172, and it's section 8.6 of the operating agreement. Appellant's role was confirmed by Blue Velvet's former general manager, bookkeeper, and former CPA. That's Exhibit A, pages 33 through 37, 77 through 78, and 123 through 124. Appellant is listed as the owner of Blue Velvet on the corporation's seller's permit application, Exhibit C, page 89. Appellant is identified as the sole managing member on Blue Velvet's Statement of Information and Articles of Organization filed with the Secretary of State, Exhibit A, pages 83 through 85, and appellant conceded his role as the managing member during the appeals conference, and that's noted in Exhibit A, pages 15 through 16. As the managing member, appellant had a fiduciary duty to act on Blue Velvet's behalf. The duties of a managing member of an LLC include a broad responsibility for any matter related to its activities, including its sales and use tax compliance. You can find that duty in Corporation Code sections 17701.02 subsection N and 17704.07 subdivision C. Appellant asserts that another person should be held responsible for the liability. He argues that he was not a responsible person because he did not have direct, hands-on involvement with Blue Velvet's sales and use tax matters. However, appellant was Blue Velvet's tax matters member. He was the owner and sole corporate officer for the entire life of the business. Absent an express limitation on appellant's duties and powers, appellant was responsible to ensure the corporation's sales and use tax obligations, even if he had delegated those tasks. And you can find that in, precedent for that in in the case Commercial Sec Co. versus Modesto Drug Co., which is 43 Cal App 162, page 173. Here it is undisputed that appellant was Blue Velvet's managing member, and there's direct evidence that appellant's powers and duties included Blue Velvet's sales and use tax compliant. Furthermore, regardless of what anyone may believe, more than one person may be found to be a responsible person for a corporation's unpaid liabilities. Based on our evidence, appellant, as the sole owner, corporate officer, managing member, and tax matters member of Blue Velvet, was responsible for handling and had a duty to act with respect to sales and use tax matters. As to the fourth element, the evidence establishes that appellant's failure to pay Blue Velvet's tax liabilities was willful. Failure to pay is willful if the person had knowledge that the taxes were not being paid and had the authority and ability to pay the taxes but failed to do so. As to ability, appellant has conceded, and the pre-hearing conference order confirmed, that Blue Velvet had the ability to pay the taxes at issue. As to knowledge, the evidence shows that appellant knew, or should have known, that Blue Velvet failed to pay its sales and use tax liabilities for the periods at issue. The evidence contains several emails from the company's general manager to appellant, specifically notifying him of outstanding sales tax liabilities, including one on February 1st, 2007, regarding a late payment of fourth quarter 06. April 24th, 2007, regarding a potential non-payment of first quarter 07, and November 16th, 2007, regarding a late payment of third quarter 07. You can find that in Exhibit A, pages 177, 179, and 207 through 209. Another email to appellant, dated October 8th, 2007, discussed the corporation's negative cash flow. After informing appellant that vendors had changed Blue Velvet's terms to, quote, collect on delivery, and of the outstanding accounts payable, the general manager stated, quote, if we were closer to hitting break even, that amount would not be concerning. As it stands now, every dollar that we make goes into keeping the operations running, including revenue generated for sales tax. It's Exhibit A, page 271. Earlier today, Mr. Brandeis stated that it is grossly obvious that underreporting had occurred. Appellant was included in other emails specifically related to sales and use tax matters, including an exchange with the general manager relaying information from Blue Velvet's CPA, dated October 10th, 2007, and another with Blue Velvet's bookkeeper, dated December 12th, 2007. That's Exhibit A, pages 181 and 27. The record includes many other emails either to or from appellant regarding Blue Velvet's budget and financial matters. That's Exhibit A, pages 178 through 179, 186, 189, 191, 193, 195 through 196, 210, 212, 258 through 259, 284, 303, and 310, including daily sales reports from Blue Velvet's bookkeeper, Exhibit A, pages 40 through 66. Given that he was apprised of the financials of the corporation, and given that it was grossly obvious that underreporting had occurred, I think it is clear to say that appellant had knowledge of Blue Velvet's unpaid sales and use tax liabilities. Furthermore, appellant listed Blue Velvet's 2009 tax liability to the Board of Equalization on Schedule E of Blue Velvet's Chapter 11 bankruptcy petition filed April 29, 2010. He filed a declaration on September 27, 2010, declaring that he was a member of the LLC and acknowledging the department as the corporation's largest creditor. He also acknowledged that he could be held personally liable for the liability. That's found in Exhibit A, pages 68 through 70. Thus, appellant knew Blue Velvet failed to pay its tax liabilities on, or at the very least, after they became due. Appellant met with the department on October 7, 2009 and February 11, 2010 to discuss the audit, and received the November 1, 2010 audit report that's documented in Exhibit A, pages 116 and 117. Appellant also signed 3 BOE 122 forms, waivers of limitation in 2009 and 2010 related to the audit. That can be found in Exhibit A, pages 93 to 95. As the business's sole owner, corporate officer, managing member, and tax matters member, appellant had access to the corporation's books and records. During the audit period, Blue Velvet underreported its taxable sales by several $1 million at an error rate of over 300%. This amount of underreporting could not have escaped appellant's notice. It is more likely than not that appellant knew that Blue Velvet failed to pay its sales and use tax liabilities when they became due. Appellant claims he was a passive investor in Blue Velvet. However, the evidence shows that Blue Velvet was actively involved in the business operations, even stating that he received weekly emails, monthly meetings, he was present at the business location at least monthly, and he made suggestions regarding its operation. As for appellant's authority to pay taxes or cause them to be paid, as the sole owner, corporate officer, managing member, and tax matters member, appellant had authority to direct the affairs of the corporation throughout the liability period, including authority to pay taxes. Nothing indicates that his authority was limited in any way. Direct evidence that appellant had authority to make payments of tax is a business check signed by appellant to the Board of Equalization on April 27, 2009. That can be found in Exhibit C, page 207. It's also in Exhibit A, but a clearer copy is in Exhibit C. Appellant also signed a business check to West Coast Produce on February 3, 2009, which is further evidence that appellant had authority to make payments on Blue Velvet's behalf. That can be found in Exhibit A, page 91. Appellant was also identified by Blue Velvet's former general manager, bookkeeper, and CPA as a person able to make financial decisions on behalf of the business. A record of that can be found in Exhibit A, pages 33 through 37, 77 through 78, and 123 through 124. Furthermore, appellant was the sole owner, corporate officer, managing member, and tax matters member. Without evidence to the contrary, those positions confer appellant with authority to direct Blue Velvet's payment of tax. As the evidence shows, Blue Velvet collected sales tax reimbursement, and appellant was a person responsible for handling Blue Velvet's sales and use tax matters, and appellant's failure to pay Blue Velvet's tax liabilities was willful. Appellant argues that he should not be held personally liable because he had delegated the corporation's authority to pay taxes to another person. However, there is no evidence that appellant was relieved of his authority or duty as the sole owner, corporate officer, managing member, and tax matters member to act on the sales and use tax liabilities. Which brings our attention to issue 2, whether there is reasonable cause to relieve the finality and failure to file penalties. I didn't hear the appellant argue this matter today, but it was included in the pre-hearing conference order, so I wanted to address it. Revenue and Taxation Code Section 6592 provides that penalties may be relieved when a finding that the person's, in this case, Blue Velvet's, failure to make a timely return or payment is due to reasonable cause and circumstances beyond its control and occurred notwithstanding the exercise of ordinary care and the absence of willful neglect. Statute requires that the person seeking penalty relief must submit a statement signed under penalty of perjury, setting forth the facts upon which the person bases this claim for relief. That can be found in Revenue and Taxation Code Section 6592, Subdivision B. Appellant submitted 4 CDTFA 736 forms, which are requests for relief of penalty, collection cost recovery fee, and/or interest, dated November 6, 2007, and that can be found in Exhibit 11. One is a request for relief of collection cost recovery fees, Exhibit 11, page 7. However, collection cost recovery fees of the primary account, in this case Blue Velvet's, are not subject to dual, and were not included in appellant's dual determination. 2 are requests for relief of penalties which relate to periods of 2010 which have been removed from appellant's liability and are no longer in dispute. And then 1, Exhibit 11, page 3, is related to the finality payment penalty for the audit liability period. Appellant's argument that Blue Velvet lacked funds at the time of the returns became due does not establish reasonable cause or circumstances beyond its control necessary to grant him relief of those penalties, especially as evidence shows Blue Velvet had funds available to pay its liabilities, but chose to subsidize its business operations. Furthermore, appellant's argument that he lacked sufficient knowledge does not relate to reasonable cause and circumstances beyond Blue Velvet's control. And as we discussed earlier, appellant did know that Blue Velvet failed to pay its liabilities. Therefore, relief of penalties is not warranted. Appellant raised a 3rd issue regarding whether adjustments to measure Blue Velvet's sales and use tax liabilities for 4th quarter 09 should be made. It is the taxpayer's responsibility to maintain and make available for examination on request all records necessary to determine the correct tax liability. You can find that citation for that in Revenue and Taxation Code Sections 7053, 7054, and Regulation 1698B1. Here, the department had to estimate a liability for this period because appellant did not provide adequate records. In instances such as this, when sales cannot be verified by a direct audit approach and reliance cannot be placed on the taxpayer's records, the department must calculate the sale from whatever information is available, including indirect audit methods to determine the tax liability. You can find background for that in Audit Manual Section 0404.05 and 0407.05. The department used Blue Velvet's bank statements to establish its taxable sales, which is a recognized method of determining whether the taxpayer had reported all sales. The background for that is Audit Manual 0405.25. The department met its burden and provided a reasonable explanation for the basis of the deficiency determination, which may be found in the audit work papers and summarized in the December 6, 2018, appeals decision. Therefore, the burden of proof is on the appellant to establish why the department's deficiency determination is not valid. There is no dispute that Blue Velvet did not provide any bank statements to verify its deposits for the period at issue, 4th quarter 09. Appellant argues that only the 2nd quarter 09 and 3rd quarter 09 should be used as a basis for determining the underreported taxable sales, asserting that sales fell during this period due to the Great Recession. There is some evidence that Blue Velvet's sales declined during the 2nd and 3rd quarters of 09. However, its bank deposits for 1st quarter 2010, the period directly after the one at issue, are $28,000 greater than the deposits for first quarter '09. Exhibit A, page 27 through 28. While the record shows fluctuation over the course of the year, we do not believe appellant has established his requested methodology is more likely than not to be correct. It is also reasonable to presume that the sales for fourth quarter '09 would be higher than the previous periods due to the holidays. In an email exchange with appellant discussing the possibility of resolving some of the corporation's debt, Blue Velvet's general manager noted, and I quote, "The holiday months are the highest grossing for the restaurant industry," end quote. Exhibit A, page 271. Furthermore, there is no evidence that Blue Velvet deposited all of its cash receipts. While Blue Velvet's bank deposits may have declined over the course of the second and third quarters of 2009, this decrease is correlated with the decrease in cash deposits. There does not appear to be a similar decrease in credit card deposits. For example, credit card deposits in April 2009 were $77,000 and $79,000 in June 2009. You can find evidence of that in Exhibit A. It is a common practice for restaurants to make purchases and pay other expenses with cash from its sale proceeds, which support a finding that Blue Velvet did not deposit all of its cash sales during the entire audit period and may have increased this practice during second quarter '09 and third quarter '09. We further note that this practice of withholding cash deposits likely resulted in an overall underestimated liability. To further reduce the liability is unreasonable. Therefore, no adjustment to the liability is warranted. And finally, at the pre-hearing conference, appellant raised a new issue regarding application of two payments towards Blue Velvet's tax liability. The first payment was a December 24th, 2012 application of $23,000 from the sale of Blue Velvet's liquor license. Appellant's representative, in an email to OTA on January 30th, 2020, appears to have withdrawn the appeal of this payment. However, it was unclear, so we will proceed with our argument. The $23,000 payment was applied to Blue Velvet's audited tax liability consistent with the payment application rules in CPPM 740.180 and 707.020. The audit liability was billed on January 31st, 2011, and appellant's dual determination was not issued until October 30th, 2013. This is found in Exhibit D. As such, the $23,000 was applied to the most current delinquent tax liability by billing date for which a dual determination or successor billing has not been issued. As is evidenced by Exhibits H and I, the $23,000 was properly applied to the tax portion and the tax portion only of the audit liability. The second payment was a November 24th, 2015 application of $34,713.82 from the bankruptcy trustee. The department filed a post-petition administrative expense claim for taxes incurred during the pendency of bankruptcy proceedings, also known as an expense of administration claim, for $34,713.82 for the period of April 15th, 2010 through September 15th, 2010. Proof of that claim is in Exhibit F. At the conclusion of the bankruptcy case, the trustee paid that claim in full, according to its priority placement in bankruptcy cases, which may be found in 11 U.S.C. Section 507, Subdivision A. The evidence of which is clear in the trustee's final report, which may be found in Exhibit G. The department followed the payment application rules from CPPM 740.220, subsection 1, which states that, quote, payments by a trustee for payments of a bankruptcy claim through the bankruptcy court must be applied to the periods specified in the CDTFA's proof of claim, end quote. Therefore, the department properly followed both bankruptcy law and its own compliance policies and procedures manual when it applied the $34,713.82 to Blue Velvet's outstanding tax liabilities. Based on all of the evidence presented, the department has clearly met its burden of proving all elements for imposing personal liability to appellant. Appellant, by contrast, has not met his burden. Therefore, relief of penalties and adjustment of the audit liability is not warranted. For these reasons, we request the appeal be denied. Thank you.
Okay, thank you.
Question?
I just have some brief questions for CDTFA. Excuse me. I believe that Regulation 1702.5 has since been amended to require the department to establish actual knowledge. In your presentation, you had noted that there are numerous emails and correspondence going back and forth informing Mr. Mosher of the various financial ongoings of Blue Velvet. Did those emails cover every quarter of the liability period these days?
We only have emails going through, I believe we only have emails going through 2007, but then after 2007, in the first quarter, even before the end of first quarter 08, is when Mr. Hartstein left, and we've not been given any evidence that any other person was managing Blue Velvet at that time. So the fact that he was the sole, owner, corporate officer, all of those things, we would take that to mean that he had actual knowledge at that time.
Okay. Regarding the correspondence that we do have, I noticed that some of them had mentioned specifically tax liabilities of the entity. Others had not. They were just general financial.
Correct.
And you were saying those go to just establishing that he was involved in the finances. He, I guess, should have known, for lack of a better word.
Correct.
Okay, thank you. Sorry, my second question. I'm looking at the daily sales reports, and this goes to the collection of tax reimbursement. There's obviously items here listed as sales tax BV, sales tax MX. How does CDTFA know those amounts were actually collected from customers of these entities?
Right, let's see exhibit. I remember seeing.
Could you repeat your question? I'm sorry.
Sure, I understand that there's financial reports that from the entities that CDTFA has presented. I see that sales tax is reflected on those documents. But how do we know that these are just not amounts that the taxpayers accrued and will pay, rather than amounts that were collected from its customers?
Yeah, so on the, excuse me, on the daily sales report, it shows all the different categories and has the sales tax collected and the grand total up top. And then if you look down at the bottom, the second to last line in the chart shows Micros report, which for my knowledge is a point of sale type system. And so this is the daily consolidated total revenue, which matches the entire amount that they have. So based on that, I would assume that the sales tax was actually included or charged as part of those sales.
Because they're reflected in the POS.
That's what it appears, yes.
Okay, thank you. That's all the questions I have.
Hold on just a minute. I guess I want to ask CDTFA, following up on a question I raised earlier, the liquor license payment, is that considered a voluntary payment or an involuntary
Oh, I'm
payment?
sorry. I referenced the code section, or the CPM section, but I can reference it again here. It's not considered a voluntary payment, so CPPM 740.180 has to do with liquor licenses during its sale of assets of a debtor during bankruptcy. And I can read it for you, or you can just look it up.
I'll look at it.
Okay.
But yeah, so that's my understanding is the liquor license is money that CDTFA collects from a different agency,
Well,
correct?
we collect it directly from escrow.
Mhm.
So we place withholds on transfers of liquor licenses, and then it goes outside of the bankruptcy, is my understanding. But it only happens during bankruptcy that we do this, that we would then place a withhold of the transfer and then collect it, directly out of escrow without like passing through to the, through to the business and then to us, if that makes sense.
And all the money was applied to the tax liability and the audit, so it reduced the corporation's tax liability before the appellant was billed as a responsible person.
When you say all the money, you mean all the money from the liquor license payment? Okay.
23,000.
I guess I wanted to ask a question about, I don't have the exhibit page. It was an August 2011 ACMS note that I don't know if it was I don't recall if it was one of the ones that you referred to in your arguments when you were when you were citing to, I think it was in Exhibit A.
Do you recall?
It was August 2011, and it was, one second. I will see if I can find it and get back to you. Do you have any questions?
No questions.
Okay. I'll say, I'll look and see if I can find the page that I was asking about.
Okay, I think I might have found it.
Okay.
Are you referencing page 97?
I don't remember. I'll get back to it. Right. I just had a note asking about it. All right, I'll say that CDTFA, if you've concluded your presentation at this time and my co-panelists have their questions at this time, we now have move on to appellant's rebuttal. And Mr. Brandeis, you can begin your rebuttal whenever you are ready.
The department's statement that, where they take my statement that underreporting is obvious to anybody that looks at these transcripts as knowledge. I stand by that statement. Anybody that looks at these transcripts and understands the restaurant, it should be obvious that there's underreporting. I have no evidence my client ever saw these transcripts.
When you say these
These
can
are
you tell me what exhibit page are you looking at? Is this the one that
This
you-
is
one page that you
this is what is
submitted?
known as a 414M.
Oh, the 414M.
So, I don't know that my client's ever seen the 414M. I don't know that my client has ever seen the sales tax returns that are filed. I have copies of the tax returns that were filed for the period of 2007 when Mr. Hartstein was there. And I find some of these extremely troubling. First quarter 2009, line 1, gross sales, 374,219. go to line 1 of 2007, 389,000. But then we have another return, also first quarter, showing sales of 15,575. Both of them are first quarter 2007, both under the permit number 100-632-545. Are they keeping, is the bookkeeper keeping 2 sets of books? What are they showing my client? Can you show me one email? They cite numerous emails. Can you show me one email where they inform my client we're grossly underreporting sales, just to let you know? No. She pointed out that there's emails saying we're short on sales tax. What they're saying is we don't have the money to pay the sales tax that we're telling you is due. You need to kick in more money into the business. That's what they're telling him. They're not telling him, hey, we're underreporting, just to let you know, you're overseeing this. So it's a little misleading to what they're pointing out. There's not one email that makes him aware that there's this gross underreporting going on, but there are several returns for the same periods with vastly different gross amounts in terms of gross receipts. I don't know what's going on with the bookkeeping. Is this information that they're withholding from my client? I find no evidence that he's aware of what's going on. Again, Martha was hired by Robert. Martha was managed by Robert. Again, I've never met Martha. I've never met Robert. But what's going on is something that's going on at that level, and it's not being conveyed to Mr. Mosher. He has no knowledge. CPPM section 764.110. This is under establishing an RTC section 6028 dual determination. Number 2. This is giving guidance to determining who is responsible for the periods of liability. Who was responsible for sales and use tax matters while the sales occurred and when the taxes became due. For 2007, that was Robert H. My client is a real estate developer. He's not an accountant. He's not an auditor. He's not a CPA. He only knows what they're telling him. He only knows what they're telling him because he trusted Robert. And there's no evidence to show that he's looking at the amounts that, well, you never saw transcripts. And so somebody can create a return and show you and say, hey, these are the returns, or here's an email telling what the numbers are. But how would anybody know that those numbers are accurate? But again, there's no email saying, hey, we're underreporting. There's emails that say, hey, we're short of cash this month. We need you to put in more money. But there's no email saying that, hey, just to let you know we're underreported. We're not paying the tax. The department's putting a lot of emphasis and focus on titles here. There's a lot of emphasis on he's the managing member. It's a single member. This is a partnership. This is a partnership between Blue Velvet LLC, which is a single member LLC, and Robert H. Robert H. contributed approximately $150,000, somewhere in there. Does employees do that? Do employees contribute money to a venture? That sounds like a partner. There's emails, and I know the department has seen them. There's emails, especially the departing email where Robert H. departs, separates from the company, where he apparently gave away some laptops as bonuses to employees without Mr. Mosher's knowledge, and Mr. Mosher's told Robert to get those laptops back. I didn't authorize it. Well, so the next email is from Robert H. to those employees, and he states in there that I thought I was a partner, but apparently I'm not. I thought I had the authority to do this, but apparently he believes, he knew it was a partnership. He believes that he has the authority to act as a partner. He did have the authority to act as a partner. But in those emails, when he's separating ways and he starts giving away laptops, yeah, if you were the guy who's kicking money into this business, you would say, I want that back. Our partnership is ending. I'm going to give you back your partnership interest, and these laptops that you're giving away, I want those back. That's essentially his money. And so like I said, the department is focusing a lot on titles here. This is a partnership. Robert was a partner. And again, if you read 1702.5, subsection B1, it lists these various titles: member, officer, member, manager, employee, director, shareholder, partner, or other person having control or supervision. And then the very second sentence from the left of that section, it says, the fact that a person possesses any of the aforementioned titles in and of itself is not sufficient to establish that the person is a responsible person. But if you listen to their testimony, they're saying, oh, if you're a managing member of an LLC, you have the authority. Boom, you're a responsible person. The regulation is saying you're not. That's not enough. They have to establish that you were in control. You had, as it says in the audit manual, we need to establish who is the person who had control and the duty and the responsibility for filing and paying the sales and use taxes. During 2007, it was Robert H. On the issue of tax reimbursement and these reports. The reports that you have in the system looks like a little worksheet that was created by, I don't know if it's Martha or Robert, somebody in the accounting department created a little worksheet. There's no printouts from Aloha or Micros or any POS system. So again, those worksheets are in an internal document, and as such, they are insufficient to establish proof of reimbursement. Statements by Robert H., well, we know he lied in his statement after he's contacted by the collector informing him he's being investigated as a responsible person, and he lies about his role in the company. You know, I don't know that I can believe anything that he says. And when I look at what's going on with these returns for multiple amounts and what was filed, I seriously question the ethics of the responsible person who was filing those returns. I don't know that I would buy any statement by that person. And the bottom line is, and again, I disagree with the department, you don't presume sales tax reimbursement. The civil code outlines the facts that create the presumption. Those are not present. The general comments that you see, written by the DPA. He was never out there, he never saw any records. Auditor's comments all over the map. Senior tax auditor, and again, this is on the issue, 517 hours. You know, there's about 2,000 working hours in a year, just to get to the point of the competency of this auditor. That means this auditor can only complete 4 restaurant audits a year. He's a senior tax auditor. That's absurd. That is absurd. He is grossly incompetent. The methodology, he doesn't know how to write audit comments, so the DPA has to write them for him. And now they're trying to salvage this garbage. I mean, if you're going to uphold responsible liability on some internal worksheets and a questionnaire, then why would anybody need to get any documentation? Why get rid of the Form 1296? Get rid of these requirements saying get evidence of tax reimbursement. All you need is a questionnaire. All you need is, that's weak. To Ms. Brown's earlier position, is that always, there's a list of evidence that is listed in the CPPM. They've gotten the weakest evidence, They're required to establish that this happened, and the best they can do is a questionnaire. If that gets upheld, then this is really sort of a pseudo requirement that the department has to prove tax reimbursement. That's all I have.
Okay. Go ahead.
Sorry, just one brief question, Mr. Brandeis. I was wondering if you could perhaps elaborate on the Micros. Micros is the point of sale system used by Blue Velvet. All right.
So again, I wasn't there. I established a working relationship in late 2013. I've never seen any Micros reports. I've never seen any sales tax receipts. I'm pretty knowledgeable about restaurant POS systems.
Is Micros one of those?
Micros is a restaurant POS system. Would I say I'm an expert on it? No, but most restaurant POS systems have the ability to download data. Today, auditors would download the data, or they'd request a download. Auditors frequently go in and make undercover buys. People post pictures of receipts on Yelp. There's all sorts of ways, and this auditor was there while the business was still in operation. He could have made copies of the receipts. He notes that the receipts, sales tickets, are available to him. He went to the restaurant, he could have asked them to generate a receipt and immediately void it so he could see what receipts look like. Do they have tax reimbursement, not have tax reimbursement? He could have done all these things. He just chose not to. It sort of fits this general degree of incompetence in his overall audit approach. He failed. He failed to do his job, and the requirements is set forth in the audit manual and the CPPM to get this evidence. The strongest evidence, the bold items that are listed in the CPPM, they don't have one.
My concern sort of reflects what you've been saying, is that we don't have, and typically in these cases you would see a POS, a receipt or an invoice and some indicating that tax reimbursement was charged to the customer. Here we're relying on, it appears, these daily sales reports which show that the Micros amounts from the POS, and I'm assuming any amount that's total from the POS would include tax reimbursement if it also matches what's being said here on the daily sales reports as sales tax BV, sales tax MX. Do you have a response?
Yes, I have a response.
Okay.
So again, I haven't seen any Micros reports. Again, I think what you're looking at are internal worksheets created by the bookkeeper. But even if they had a copy, a printout of a Micros report, and it listed, sales, and let's say it listed tax below that. That could be, and again, an internal calculation by the system calculating tax on the gross total X tax. It doesn't mean that the customer saw a receipt with tax reimbursement or any notation to the effect that tax is included in the retail selling price.
Thank you. Did you want to respond to that?
I'm not sure why the corporation's internal accounting records would show that they were collecting tax reimbursement if they weren't collecting tax reimbursement. An appellant has no objection to reducing the tax reimbursement collected from the bank deposits when we were determining the audited taxable sales. I think appellants in a difficult position when they have to impeach their own internal records, and they don't. That's our position.
Was CPTFA ever able to match any of the amounts on any of these reports to, say, bank deposits? I know you had received some bank records.
Can I interject on that point?
Sure.
Typically, a restaurant doesn't send all the receipts taken in to the bank. The reason is credit card tips are generally paid out with cash receipts for the day. So, say you were a server, we had $100 in credit card tips. You would take the cash receipts that you received, and they would offset the credit card tips at the end of the day with cash received. So you don't, the cash doesn't, all the cash doesn't make, that's a normal operating procedure of any restaurant. You're not going to be able to look at deposits and tie them to a report. That's just generally, that's not the way it works.
You asked if we were able to match the daily financial reports to a bank statement. I'm not sure that we
Okay, that's fine.
able to do
That's
that.
fine. I'm just curious.
Yeah.
Do we have credit card information in this case? Any,
So I do know that, like, we did submit in our exhibit 2 with our original response brief, and then, you know, we included that in our exhibits with our pre-hearing conference statement. And not all of those documents are in here. The audit working papers are not fully represented in here, and so.
If I could add, the bank statements which they have show merchant card deposits. So even though they might not have a 1099-K, they do have merchant card deposits per the bank statements.
All right, and let me just add, as I said at the beginning, this is a courtesy copy. We're doing our best to collect what we, our support staff is doing their best to collect what we think you mean. So if, for all parties, if there's something that we've left out of this binder, there's pages missing, we're relying on you to say there are pages missing. And in any event, ultimately the exhibits that are technically admitted are the ones that you submitted previously and provided to the other side as well as to OTA. So if there's pages missing from this copy, that doesn't mean they're not in evidence, but again, point out to me if we missed pages.
I did want to note that in Exhibit A, page 66, which is the daily sales summaries, it's for December 27th of 2007. It shows cash of $114,863. And then in the audit, when we scheduled on Schedule 12A4, column C, we had cash deposits for Blue Velvet of $7,860. So that shows that not all the cash that was collected, or at least on their daily sales reports, was deposited into the bank account.
Again, that's normal operating procedure for a restaurant. All the cash does not make its way to the bank. The majority of the cash is used to tip out credit card tips to the employees. And there's no requirement in the law requiring a taxpayer to make any cash deposits ever. Cash could be used to pay vendors, a number of other things.
okay, thank you. I don't have any follow-up questions on that.
I guess I had one, I don't know if there was anything further from CDTSA on the last part. Okay, I wanted to follow up with appellant about the issue of the, issue 3 about the dispute about the measure for the fourth quarter of 2009. Am I correct in my understanding from what I've read of the case that appellant and Blue Velvet didn't provide bank statements for that quarter? For fourth quarter of 2009?
So, again, they brought me in 2013. By the time we got to an appeals bureau hearing, it was, I'm going to guess, 2015. Maybe 2016, I don't recall the exact dates. We had a hearing, and then with Corin Saxton, and then he left, and we had to have another hearing with another Keith Long, I want to say. So we, you know, this issue came up, and now it's like 2017. I mean, the business has been closed for 7 years, and you know, we can't go to the bank and say, hey, can you give us a bank statement from 7 years ago? So we didn't have it. But what we're noting here, excuse me, the Great Recession, if we can go back and sort of remember this time, and if you look at the bank deposits, which both the department and the taxpayer are accepting as a reasonable amount for the gross receipts. So we look at first quarter of 2009, we have almost 445,000 in deposits into the Blue Velvet account. Net deposits are 438,000. Remember, if we can just sort of go back and think about what was happening in this time in the country and in the world, the stock market meltdown happens in late 2008 and is continuing, and it is the worst financial meltdown in my lifetime. I'm 50 years old, and people compare it to the Great Depression. So, you know, the sky is falling kind of a thing going on here. Sales declined from first quarter 2009, net deposits of 438,000. The following quarter, they plummet. The monthly amounts are plummeting. They go down to 241,000. And third quarter, they're continuing to fall to 191,000. Our position was, we don't have the bank statements for the next 2 quarters. Let's take the 2 quarters preceding it. We know that sales are declining, and let's average them together. It should be a reasonable estimation of what deposits would have been. And the department said, no, we want to grab first quarter 09 too. Why? Because that quarter just raises the liability. That's the only reason that they want to grab it. But you have to ask yourself, by fourth quarter 09 and first quarter 010, was the economy better or worse? It was terrible. Things were terrible at that time. Things didn't get better.
Alright, so you're just arguing, if I understand correctly, that those records were just unavailable to you or to the LLC. You couldn't produce them.
We couldn't produce them. By this time, it would be like, you know, trying to go back and get bank statements from whatever it was at that time, 7, 8 years ago.
I'm sorry, that triggered a question from me to CDTFA. For the first quarter 10, was there a non-remittance assessment for that quarter? And I'm wondering if that amount was higher than what the department had assessed for fourth quarter 09.
I'd have to look that up to see, but I think there was a non-remittance for that quarter. I can see what the amounts are for those.
Sure. Okay.
So for the fourth quarter of '09, the reported amount of tax was $12,453, and then in the first quarter of '10, they had a reported self-assessed amount of $17,868. So they reported more in the first quarter than they did in fourth quarter of '09.
Okay, thank you.
Oh. I do have that page I was going to ask about. I think actually my question is directed to Helen. Exhibit A, page 95, 96. 95 and 96. It starts on 95. Are you at the page?
Exhibit A, page 95.
Yes, I'm talking, it's 95 of Exhibit A, it's page 403 of the PDF, if that makes it easier.
I'm looking at
It's a-
Exhibit A, page 95 of 319, and it's page 402 of the 902-page PDF.
Scroll down one page, sorry. Page 403,
Page 96.
96, that's it, okay.
Okay.
96. So this appears to be what they call an ACMS note. It's, at the time it was Board of Equalization, now CDTFA's internal system where they keep track of phone logs and phone contacts that they have with different parties about cases. And this appears to be a notation of a discussion with Mr. Mosher.
Okay.
Alright, I guess I just wanted to hear what appellant's position is about this, where he says that there's a line in here I wanted to ask about. Oh, when asked why the sales tax wasn't paid, he said that the managers didn't pay it. They were trying to keep the business afloat by paying suppliers and payroll. I guess my question.
So this note, this ACMS note, is dated
2011.
By this time, he became aware of the underreporting. He knew that there were significant cash shortfalls. He was funding those, personally funding those, and he must have become aware that they were using the cash shortfalls to keep the business afloat. And again, given that he's already received now work papers from the auditor by this time, he's probably come to the conclusion that they've used the sales tax to keep the business afloat, meaning Robert H. I'm going to say Robert H. because he's the one who had operational control.
Okay, so appellant's position is this refers to what was going on in 2011, not during the
Well, by
liability
2011, Robert's gone. Martha Wiener was still there until 2009, sometime in 2009. But by 2011, the business is closed. It's finished.
I'm just saying this so that your position is that this was referring to a period where Mr. Mosher knew that this was that the taxes weren't being paid, but this was after the liability period that we're looking at.
After the
here.
liability period, yes.
Okay. Do you have anything further?
Yeah.
All right. Have I heard everyone's arguments? Is there anything else that we need to address before we close the hearing today? Okay. Then I will say that given that arguments have concluded, the record is closed and we will be issuing a written opinion within 100 days. Thank you all very much for your participation today, and I believe I can now say that we are off the record.
Zoom. We are ready to hear the appeal of Arnold A. Arenas, case ID 190-44660. It is 1:27 p.m.
Good afternoon, my name is Richard Tay. I'm the lead ALJ for this hearing. To my left is Judge Doug Bramhall, and to my right is Judge Win Dang. Although I'm conducting the hearing, we are all co-equal decision makers in this case. And I believe we have both parties present, Mr. Arenas and Franchise Tax Board. Everyone's here? Good. Well, welcome to the OTA. I just want to start by we don't have any new evidence, is that correct? Mr. Arenas, no? Franchise Tax Board?
That's correct.
Okay. I'd like to just acknowledge the court reporter. She's very good, but I will ask you to please not speak over one another and speak clearly and at a moderate pace just for her sake. Any questions before we go on the record?
No questions.
Okay. Let's open the record. Good afternoon. We are opening the record in the appeal of Arnold A. Arenas before the Office of Tax Appeals, case number 190-44660. This hearing is being convened in Cerritos, California on February 19, 2020 at 1:29 p.m. Today's case is being heard and decided equally by a panel of 3 judges. My name is Richard Tay, and I'll be acting as the lead judge for the purposes of conducting this hearing. Also on the panel with me today are Judges Doug Bramhall and Win Dang. Will the parties please just introduce themselves for the record, beginning with appellant, please.
Sure, I'm Arnie Arenas.
That's good enough, thank you.
Desiree Messina from the Franchise Tax Board. Sonia Woodruff for Franchise Tax Board.
Thank you. I just want to read the issues so that we're on the same page and read it into the record. The issue is whether appellant has shown that FTB erred in disallowing unreimbursed employee expense deductions for the 2012 tax year. Is that your understanding, Franchise Tax Board?
Yes, it is.
And Mr. Arenas?
Yes.
Okay, thank you. Prior to the hearing, we circulated the exhibits submitted by both parties in a file we'll call the hearing binder. It contains appellant's 3 exhibits and FTB's exhibits A through I. I believe there were no objections to admitting the exhibits into evidence. Is that correct, Mr. Arenas?
Yep.
Okay, and no objections, Franchise Tax Board?
No objections.
Okay, the exhibits will now be admitted into evidence. I'd like to give you guys the opportunity to present your case. Mr. Arenas, I believe you wanted to make an opening statement, and I'll give you 5 minutes to do that. And Franchise Tax Board, if you'd like, you can have 5 minutes to make your opening statement. After that, Mr. Arenas, I'm going to give you an opportunity to give your presentation. Before you do so, I'm just going to swear you in as a witness, just because I believe you'll be testifying to some facts based on your your presentation.
Okay.
Okay. So why don't we start with opening statements? Mr. Arenas, please. You have 5 minutes.
Okay. First of all, I'm not a tax expert by any means. I've done my taxes every year for over 50 years, so I know how to do that part. And I guess this is regarding the year 2012. I don't know. Call it an audit or what it's actually called, but that year I actually paid, and I had a pretty good year as far as professionally. I actually paid in taxes were withheld, federal and state, over $26,000. So I did pay my taxes. The refund after I did my taxes was actually intercepted. So it went straight to child support. I think it was around $3,000. I don't know the exact numbers, but it went straight to my ex-wife. So nothing. The refund didn't benefit me. I mean, it did for my children, of course. And then in September on September 16, 2016, I found a letter basically talking about this situation, and I've been doing my taxes with Bliss, Dan Bliss is the name of his name, I don't know the name of his company, but he's been doing my taxes every year in San Diego. And I asked him about it. He said that he probably has around 400 or 500 clients. And
Mr. Eunice, do you mind, I'm so sorry
Yeah.
to interrupt you, but it sounds like you are testifying to some of the facts that you maybe want to discuss a little bit more in your presentation. If it's okay, I'd like to just swear you in as a witness now so that so that your testimony can include all of these things that you're referring to.
Okay.
Is that okay?
Yeah, sure.
Okay. If you don't mind, please stand and raise your right hand.
Okay.
Do you swear or affirm that the testimony you will provide shall be the truth, whole truth, and nothing but the truth?
Yes.
Okay, thank you. Again, I apologize for the interruption, but please proceed.
That's okay. So I asked Mr. Bliss about this letter, and he said that out of his 400 or 500 clients, that maybe 5 to 8 of them got this same type of letter. So he kind of coached me. He said just give them a call and ask them what they need, and just go ahead and oblige to whatever they need. I said that's fine. I dealt with 2 people, Yahoshka or Kuyu, I don't know, I totally butchered that, and Annette Thomure. I probably dealt with Annette, it was from 2016 to current, probably Annette most of the time, and so just going back and forth, they were asking me, for what they needed, and I would just go back and forth for about 3 years in that whole time process. And then I realized that I know in the past that I have a chance to actually be heard like I am today. And I asked Annette, I said, I never received that in this situation. And she said, you did not. And I said, no, I never had that option to actually be heard in court. And she said, oh, okay, well, then we're going to have, what we're going to do is we're going to refund you, they were going to give me some kind of a credit or a refund, and I think it was of another year, I can't remember which year it was, but so they sent me another refund, and that was probably around $3,000, and again, that was intercepted by child support, so I didn't get any credit for it. My ex-wife and my children did. And then after a few months, this kind of escalated into the situation. So that's why I'm here. And on a personal note, that year was really my last great year in my professional life for some reason. Call it karma. I don't know what you want to call it, but I've been struggling financially. I'm probably struggling to make about $50,000 a year. Companies being acquired, tough time finding jobs. But I mean, the good news is I do have a good job now. I started last week, so that's a good thing. And then the last thing, my last point is, as a taxpayer, I mean, the money that we're talking about is $3,000 here, and this happened in 2012, and the letter I received was in 2016. The money, the effort, the labor, this paper, these guys, you guys, I just see, wow, there's way more than $3,000 put into this whole process, and that, as a taxpayer, personally, I'm pretty upset about that. But other than that, that's kind of my opening. So, yeah.
Thank you, Mr. Arenas. Just want to turn to Franchise Tax Board. You have 5 minutes for your opening statement.
Thank you. Good afternoon, panel. The sole issue before us today is whether respondent erred in disallowing appellant's claimed unreimbursed employee expenses. Under income tax law, the taxpayer must have had the right to obtain reimbursement from the taxpayer's employer, and he must demonstrate that the expenses had a business purpose. Appellant has not provided any evidence that he sought available reimbursement from his employer, which his employer denied. Nor has he provided any evidence to show that his claimed expenses had a business purpose. Therefore, appellant is not entitled to deduct his claimed expenses as unreimbursed employee expenses. Thank you. That concludes my opening statement.
Thank you, Franchise Tax Board. Mr. Arenas, I'd like to proceed by giving you an opportunity to make your full presentation. You have 15 minutes, so please proceed whenever you feel comfortable.
Okay. Yeah, should take 15 minutes. Well, my first point is, I think the biggest request from the ladies I talked about earlier was I was trying to get some information showing that I did work remotely from home, and that took a little while, but I did get it, and I think it's in the paperwork that I worked as a district sales manager in California. The corporation was in New York. It's Leupold Pharmaceutical. I just could never understand why I proved that I was living in California. I wasn't commuting to New York every single day to go to the office, but I did get a letter basically stating from HR that I worked remotely from home during that time, 2011 and 2012. I spoke with my Mr. Bliss, my tax consultant, and he basically said that that's significant. If you are working from home, again, I'm not a tax expert, but you can accrue, you can 10% of the cost that goes to like an office space, in which I've done that pretty much most of my career because I've always worked in pharmaceuticals and working from home, so I was familiar with that. But in some of the paperwork, they said, well, you never really proved it, but I finally did. So and we have that information. As far as the actual reimbursement from the company, all the original receipts, they gave me a diners club, and all the original receipts went to the company, and so all the receipts that I have that are in this stack of paper and theirs and yours, those are all originals, and those I was not reimbursed for those, and those came out of my pocket. And all the reimbursement from the company, they kept the originals, and they're at the corporate office there, or whatever they do with it now. I don't know. It's been quite some time. My next point is, I believe, and that was using an outdated expense policy. I did send the new one. That should be in your guys' information, an updated policy. But she was using the very first one I sent her, and then the updated policy actually has a date on there, dated in 2012. And some of I guess on the general correspondence, they said I didn't provide detailed receipts where every receipt I have is original, and I've provided it to everyone, so you should have that information as well. And my last point is that some of the expenses, the auto, the meals and entertainment, a lot of it, I did get my real estate broker's license in 2007, and I had somebody helping me out with that, and so that was kind of where a lot of the expenses was going to as well. I didn't sell any property in 2012, but 2007 is when I got my real estate broker's license, but we started trying to sell property in 2012. My first property I sold was in September 2013, so it's kind of irrelevant in this year. But yeah, I was trying to get that going, and as well as a side business. So that's kind of really my presentation, and that's it.
Okay, thank you, Mr. Arenas. I'm going to turn to my panel to see if any of my panelists have any questions. First, Judge Day.
Just have a very quick question for you, Mr. Arenas. You mentioned that you had attempted to start up your own real estate business, so as a portion of these expenses, which you're trying to deduct for 2012, those are related to that business?
Yeah, let's see, the auto, the rental car, 'cause I actually had a company car, so why would I want to rent a car? So I rented a car for my, she was my employee, I guess, and a lot of the meals and entertainment, really those two expenses.
Okay, is there a way for us to separate from what we have here in the record, what you were claiming as unreimbursed from your employer versus what you were attempting to, relating to your real estate business?
I haven't done it. I can do it. Yeah, you can do that. Yeah, but every receipt has the people that we actually had dinner with. So I did do that. The date and the money is on there, and then the people that were there. I did not break it out that way.
Okay, and as far as the home office deduction, that included dual use, one for your pharmaceutical sales related job as well as, I'm sorry, it is pharmaceutical related sales job.
Right.
And another portion for your real estate business, or was that only, the home office only pertaining to the pharmaceutical job?
Mainly for the pharmaceutical. I mean, that was kind of my bread and butter, and the real estate was on the side. I mean, for instance, like the internet. I mean, I've got I guess over 600. The company only reimbursed $25 a month, but I've got over $600 in expenses. So, yeah.
Okay, thank you so much.
There are 3 separate reimbursement policies in the record. There's a 1-pager that has a lot of your notes on it, and then there's a 26-page reimbursement policy in the name of your employer during 2012. So which one are you relying on as being the active?
It's the one pager. It's dated later, I think, I want to say November 2012 in the email on it. But yeah, it's the one, that one's pertaining to our division. Regency Therapeutics was our division. The other one was for the company Leopold, which is the mother company of all of us.
Okay, yeah. So that's the one you're relying on, is the 1-pager.
That's correct. Yeah, that was more geared for our division.
And with regard to your home office, what steps did you take to measure out, like, what percentage of your house was exclusively, I mean, can you describe for me a little more your living arrangements? I mean, you had a daughter living with you, and
yes. So it was a rental apartment. So I took the rent and the cost of the utilities, the water and electric, and pretty much anything. Really, that was it. And then took 10% from that. I guess that's how I just add it, give it to my tax person, and he does what he does with it. You know, as far as like,
let me get more specific. How was this, the 10% of the space sectioned off or segregated from the rest of the rental property space so that it was exclusively used for offices?
There wasn't much more space out there. But it was a 2-bedroom, and I segregated my bedroom. That's where I worked out of.
Okay.
Yeah.
So you did sleep in there too?
I did.
Okay.
I did.
All right. Thank you. Okay. Thank you.
Okay, Franchise Tax Board, 15 minutes for your presentation, and then after Franchise Tax Board makes its presentation, then Mr. Arenas will give you another 5 minutes on rebuttal.
Appellant claimed unreimbursed transportation expenses, travel expenses, meal and entertainment expenses.
I'm sorry, can you pull the microphone a little closer? Yeah, better. Right.
And business expenses on his 2012 tax returns. Appellant is not entitled to deduct the claimed unreimbursed employee expenses because the expenses were not ordinary and necessary, and the expenses appear to be for personal use rather than for business purpose. Appellant now claims that the expenses he incurred were from his real estate business. However, appellant's claims are inconsistent with his 2012 tax filings. On his federal return, appellant reported that he was employed as a sales manager and claimed all of the expenses as unreimbursed employee expenses. Additionally, appellant has not provided any evidence that he incurred additional Schedule C income or expenses during the 2012 taxable year from a real estate business. This can be proven by providing respondent with a Schedule C profit or loss from business. In addition, during the protest process, appellant provided documentation to show the expenses were related to his employment by providing 3 different versions of his employer's reimbursement policy. Even if the expenses were a result of Schedule C income, which appellant has not shown, appellant still must show that the expenses were ordinary and necessary and had a business purpose. Therefore, I will discuss the requirements for deductions of unreimbursed employee expenses and Schedule C expenses together. There are 2 reasons appellant has not substantiated that he is entitled to deduct his claimed expenses. First, appellant's expenses were not ordinary and necessary because his employer's reimbursement policy provides an avenue for reimbursement for all of the claimed expenses. Second, appellant has not proven the expenses were for a business purpose rather than for personal use. As to the first point, the reimbursement policy provides an avenue for reimbursement for appellant's claimed expenses. As such, appellant has the burden to prove that he sought reimbursement from his employer and his employer then denied his reimbursement requests. At this time, appellant has not provided any evidence that he requested reimbursement from his employer for the claimed expenses and his employer denied the request. Therefore, appellant is not entitled to deduct unreimbursed employee expenses because they are not ordinary and necessary. As to the second point, although appellant provided receipts to show that he incurred costs during the 2012 taxable year, tax courts have held that receipts alone do not meet the substantiation requirements because receipts generally do not state a business purpose. Based on the receipts provided by appellant, it is not clear how appellant's claimed expenses related to his job as a district sales manager based in the Los Angeles area or a real estate broker based in Southern California. Instead, the expenses appear to be for his own personal use. For instance, appellant claimed over $9,000 of travel expenses for international travel to India, London, and Paris, and domestic travel to Las Vegas and Orlando. However, appellant has not provided any documentation to show he was required by his employer to travel outside California. Appellant also claimed over $9,000 of meal, entertainment, and transportation expenses for amusement parks, restaurants, and Las Vegas entertainment. Appellant has not provided an explanation as to the business purpose of the expenses and the business relationships to the people receiving entertainment from these expenses. Therefore, appellant is not entitled to deduct these expenses as unreimbursed employee expenses or Schedule C expenses. Furthermore, home office deductions may only be deducted if a portion of the home is exclusively used on a regular basis as the taxpayer's principal place of business. Appellant's assertion that he is entitled to home office deduction fails because appellant only worked from his home office 1 day a week on Fridays. Therefore, appellant's residence would not be considered his principal place of business. Consequently, appellant is not entitled to home office deduction. Based on the controlling law and the evidence in the record, respondent requests that its action be sustained. I'd be happy to address any questions or concerns the panel may have. Thank you.
Thank you, Franchise Tax Board. Judge Kenny, any questions?
I don't have any questions.
Judge Brennan, any questions?
Yeah, question on a point of law. What authority are you relying on to assert that an expense has to be submitted and denied before it qualifies as an ordinary and necessary business expense?
That is both the IRC and the RTC. Let me find the code sections for that.
I saw in your brief the assertion, but I didn't ever see a citation to any authority that actually supports that assertion.
That is Orvis v. Commissioner, 1986, 788 F2D 1406.
I'm sorry.
I'm sorry, that is case Orvis v. Commissioner, 1986, 788 F2D 1406. And that is on page 1408.
Thank you.
Judge Brenham, any further questions? Judge Brenham? Any further? Sorry.
1 second.
Yeah.
No.
Okay. Thank you. Mr. Arenas, 5 minutes for your closing, please.
Yeah, sure. Yeah, as far as she mentioned the home office, Friday, I was only in there one day a week, so Fridays we were giving that day as an administration day to work. That's what I told them. It doesn't mean that I didn't use the office except for Fridays. I use it actually on the weekends too. In the mornings, sometimes I would do a lot of conference calls. So no, not just Friday. I was in there quite a bit actually. Now what I told them was we were giving Friday, not if you want to stay home on Fridays to do your administration work, your expense reports, everything like that, then you can do it. That's what I let them know. And as Judge Ding asked me about separating the real estate and the pharmaceutical, a lot of the meals and entertainment, a lot of them was real estate. And well, I don't even say a lot. You know, I have to look at it, but and with that, she mentioned that a lot of my business was done outside. And if you look at all the receipts, they're all in Southern California. Not every one of them, but I would say 90% of all the receipts are in Southern California, San Diego, LA, Orange County. So that wasn't. I want to just correct that as well. So I don't know what a Schedule C is. She says I'm not a Schedule C. I don't even know what that is. And that's it. Yeah. Oh, just one last thing. Yeah, my title. Yeah, I was a district sales manager. That's what I did. I had 10 reps here in California, and I was traveling all over California with my reps. And yeah, that's it.
Okay, thank you very much. Just want to turn my panel one more time. Any further questions, Judge Dang?
Maybe just one brief question. Did your employer provide you with a field office for you to work from? You would want it?
No.
Is there any place for you to go to? A local district headquarters or something?
No. No. If I had to, sometimes I would spend a night in LA and I would use the hotel as kind of an office, if you will. But no, we didn't have it. The only office was in New York.
Judge Brennan? Any questions? Okay. I think that's all we have for today. Thank you everyone for your presentations. The record of this appeal is now closed, and the appeal will be submitted for decision. We will endeavor to send you a written decision no later than 100 days from today. This hearing is now adjourned. Thank you again, Francis Export and Mr. Arenas.
Thanks, guys.
Good. Lynn, are we in?
Yes, sir.
Well, good afternoon again, everyone. Thank you for your patience today. She's going to call the case for us.
Yes. We are ready to resume. We are ready to hear the appeal of Enzo Ricciardelli, case ID 190-14233. It is 2:01 p.m.
Thank you. It looks like we have the parties here. Is there anybody else we need for the FTD or for appellant?
No, thank you,
No. Very well. And before we go on the record, I want to find out, are my panelists, Judge Dang and Judge Johnson, ready?
Yes.
Yes. Very well. Okay, let's get started. We'll go on the record. We are now on the record in the Office of Tax Appeals oral hearing for the appeal of Enzo Ricciardelli, appeal number 190-14233. Today is February 19th, and the time is approximately 2:03 p.m., and we are in Cerritos, California. My name is Elliot Scott Ewing. I'm the lead administrative law judge for this case. My fellow co-panelists are Judge John Donson and Judge Win Dang. Good afternoon. We are all from the Office of Tax Appeals, which is a completely independent body from the Franchise Tax Board. And we will base our decision only on what has been provided in the record in the appeal and the discussions held at this meeting. FTB, could you please identify yourselves for the record, your title and role?
Afternoon. David Gimmigan, Tax Counsel for the Franchise Tax Board. With me is Eddie Kuduk, also Tax Counsel for the Franchise Tax Board.
Very well, thank you and welcome. Now for the appellant.
David Holtz, I'm an attorney representing the appellant.
Scott Burkholder, representing the appellant.
Very well, thank you and welcome. Okay, so the want to make sure that you all received the pre-hearing minutes and orders and the exhibit binder electronically. Do you have those?
Yes.
Okay.
I have the material that opposing counsel provided. Thank you.
Okay, very well. Now onto the issue. It's my understanding the sole issue in this appeal is whether an appellant has shown that he timely identified like-kind replacement property within the 45-day statutory period in order to qualify for non-recognition of gain treatment under Internal Revenue Code Section 1031 for the 2012 tax year. Do we have that correct?
Yes.
Okay, very well. Now on to the evidence. The parties have previously exchanged exhibits. The FTB has provided exhibits A through L, and appellant has provided exhibits 1 through 7. We did not have any objections to those at the pre-hearing conference. Do we have any objection to those today? Appellant?
Your Honor, this is Scott Burkholder. Regarding an additional exhibit, there were additional exhibits 1 through 5 that were provided, I believe, on February 10th. One of those exhibits, exhibit number 4, is a calendar which is illustrating the lapse of time over the 45 days. It's somewhat confusing in that it's a calendar from 2020 and the tax year issued is 2012. And so therefore the days of the week don't actually line up to the days of the week in 2012. I just wanted to ask if we could stipulate that July 5th, 2012, which is the 45-day date at issue, was on a Thursday. That was Thursday, July 5th, 2012, and that the other date, July 8th, 2012, was on a Sunday.
Okay, are you referring to the respondent FTB's Exhibit K?
No, Your Honor, I'm responding to additional exhibits which were...
Okay, yes. So those exhibits were submitted after the second pre-hearing conference.
Correct.
Right. Okay. And so those exhibits we will be numbering exhibits I, J, K, and L.
Okay.
I'm sorry about that. Yes, we'll be numbering those I, J, K, and L, and they're currently numbered on the submission that we received from the Franchise Tax Board. I think that may be resulting in the confusion.
Okay. What I see, I have 5 exhibits from the 10th. So would they be I, J, K, L, and M?
No, I'm sorry, I believe it's H, sorry about that, it's H, I, J, K, and L.
Okay.
Yes, because G was the letter confirming the close of escrow on May 21st, 2012, which was the last one provided prior to that point.
Yes, so it is, it's Exhibit K.
Okay, yes. Yeah, and we do have that here in front of us. I'm sorry, if you could repeat the concern
Yes,
you had with that.
if you notice, this is an illustration by the FTB to show that of what the 45-day limit would be in 2012. However, it's on a calendar from 2020, and so the days of the week don't match up to the days of the week from 2012.
And if I may address that, please? I mean,
Please, go
that's fine, if I'm happy to enter that stipulation. It's really a distinction without a difference, because we're really just interested in determining the 45th day and the 48th day, and there's no extra days, or there's no, like, February 29th that pops in the difference of the year between 2012 and 2020. We're doing this for purposes of counting the 45 days.
Okay.
And the 45-day limit is a strict limit set by the statute. So whether it's a Sunday or a Thursday is, in our opinion, irrelevant, but we're very happy to make that stipulation. Because this is just done to demonstrate the regulations example, which is the top line, and then on this bottom part of the date is the actual timeline for the taxpayer here.
Okay, we understand that. We can talk further in your presentation about the distinction if it's a Sunday or not, but it sounds like where the parties are willing to stipulate that Thursday, July 5th, 2012 was a Thursday.
Correct.
And July 8th, 2012 was a Sunday.
Correct.
And obviously the relevance of those dates we'll discuss later.
Correct.
Okay, so that stipulation shall be noted. Okay, any other questions about the exhibits?
No, Your Honor.
No?
No, thank you.
Okay, so I'll admit exhibits 1 through 7, Franchise Tax Board's exhibits A through L, and exhibits 1 through 7 from appellant into the record. And it doesn't seem like we have anything else to bring with us today or present today?
That is correct.
Okay, very well, thank you. Okay, regarding witnesses, we understand that there will not be any witnesses. The presentations today will be made by appellant's counsel and the Franchise Tax Board's counsel, is that correct?
Correct.
Yes, that's correct.
Okay, thank you. So quickly, I'll go over the order of proceedings. As I said during the pre-hearing conference, there are 2 basic parts to the hearing, evidence and arguments. We've got the evidence in the record, and so now we'll turn to the arguments. We will begin with Mr. Burkholder's presentation, which should not exceed 20 minutes. Then the FTB will make its presentation, not to exceed 20 minutes. Then appellant will be allowed approximately 5 minutes to respond to FTB's arguments, if you wish. Then I and my fellow co-panelists will ask questions if we have them. Any questions at this point?
No, Your Honor.
Okay. So let's get started with the presentations. Presentation for appellant, go ahead.
Yeah, it'll be David Holtz, if that's okay, representing.
Yes, sorry, Mr.
Holtz. Yes, that's fine. All right, so first of all, I wanted to say I am so happy I wanted to come to one of these hearings. You guys have had this job for months now, or have been practicing for months. I am already seeing this as an improvement in the process, so I'm very proud that we have this new process and that you guys got this great gig, each one of you judges, and I've seen now a couple of the procedures firsthand in the back, and I'm just very pleased and proud that the state of California has improved this situation. Our firm has been litigating and exclusively litigating taxes for since, I don't know, it's been 15 years together. So we've been there and back, and congratulations to all judges here for getting a great gig and for doing this job and giving us the time. I'm sure before you got this job, I'm wondering, did you have any idea how hard it would be to have the required patience to sit and listen each day to each one of these? Because I'm sitting in the back, and I'm a tax geek, and yet I found myself thinking, I'm so happy I'm not one of those judges every day doing this. But thank you for your being here. So our presentation on this case is that this case for us is about the effective and appropriate administration of tax law. Now, our firm is special, and I'm a special attorney in the sense that we did work at IRS counsel as attorneys hired by the IRS, and we managed the administration of tax law. And when we were trained at the administration of tax law, when we were trained at the IRS, they told us a bunch of things. The policies of how to administer the tax law. They came in and told us at my level to always wear the white hat. They made it clear to us we were there only to collect and assess the correct tax. We were to effectively administer the tax law in a fair manner, balancing the interests of the government and the taxpayer when we did this. The goal was not perfect compliance. It was making sure that taxpayers had substantial compliance. And this was important because we have a voluntary tax system, even though when you go to law school and somebody says that, you laugh at first. You go, because you say to yourself, it's voluntary, but if I don't volunteer, I go to jail. Isn't that right? But it's voluntary because it depends upon each of us who are in the system, especially the people at the government, to carry out their duties in a way that gives the public confidence that they're going to be treated fairly. Because when it doesn't happen, and I've been there on both sides, I've worked for the government and I'm now, of course, on the other side. When the government does not behave in such a way that carries that goal out, the response in the voluntary system is people stop volunteering. And when it stops volunteering, eventually we'll have to get another system, another type of tax that doesn't require voluntary compliance. But this is the system we have. I remember back in that day too, we would even joke about it, that phrase in Better Off Dead, where the little kid that was delivering papers was chasing the guy and he kept saying, I want my $2. And even at the IRS, my boss and my mentor, if I or somebody in the office was doing something where we thought they were pushing it to, looking too far, holding somebody to the penny, they would laugh and we'd say something, I want my $2. So, the thing I want to point out about this case is in the policy of this 1031. And it's identified in the case Southern Pacific Trans Company versus Commissioner, where they indicated that the basic reason for allowing non-recognition of gain or loss on the exchange of like-kind property is that the taxpayer's economic situation after the exchange is fundamentally the same as it was before the transaction. And the idea behind this is to encourage the taxpayers to maintain investments. Good for the country, and that's why we're giving the incentive. So what I'm going to be saying in our presentation here is this taxpayer, our client, has been motivated by this rule, has complied overwhelmingly with the rule. We will be talking about a potential problem that occurred, but the problem that occurred was not the fault of the taxpayer. It was because of the qualified intermediary who gave him bad advice. And the amount is tiny. The amount of days that it occurred, very short. So, so let's talk about the rules that we have. They're in the 1031 rules, the rules that matter for this case. There are really two. One of them is that you are required, if you want to get this treatment, to identify properties that you will buy, replacement properties, within 45 days. You can do that in two ways. You can do that by identifying and giving it a list to the qualified intermediary, or you can do that by also contracting for the purchase. The other rule that I believe is important here, our position is important, is that you also have to purchase a property, a replacement property, within 180 days. So I think the facts, we could have probably stipulated everything, and maybe in another day we will do that for you. But I think the facts are probably not in dispute between the parties. We have the client hiring a qualified intermediary. The qualified intermediary, in two different written places, instructed this taxpayer of the deadline for identifying qualified parties. And our taxpayer, I believe it's not disputed, that the taxpayer, my client, identified the properties timely in compliance with the qualified intermediary's instructions. However, the qualified intermediary was off, picked the wrong date, wrote instead of July 5th on a Thursday, said the deadline would be July 8th on a Sunday. The reason why the days of the week are, we believe, in our presentation are important, because we're not talking just about, we're talking about 3 calendar days, but we're also talking about 1 business day for a business transaction, which I think is significant. Let's see. So the properties that were identified within, pursuant to the instructions on July 8th, there were 3, but the ones that matter to us are the Topanga property, and another one, the Channel Road property. The Topanga property is the one that was picked that also technically qualifies under the 45-day rule. I believe that the parties won't dispute that this qualifies because it was because that property was under contract and meets the 45-day rule because it was part of it was involved in a contract for sale. And in fact, our client intended to purchase that property, but like many transactions, that fell through. So ultimately, within the 180 days, he closed on the Channel Road property, a property that is in that list that was given to the qualified intermediary on July 8th, a Sunday, complying with the instructions. So, except for the sole problem in this case, except for the fact that the qualified intermediary wrote down for 2 times in writing an instruction that included a date, 1 business day, that would cause him to be 1 business day late or 3 business days, calendar days late, we wouldn't be here. And in fact, in my point of view, the effective administration of tax, we shouldn't be here. This is a case where, and we've been working these cases for years, and I've done these similar cases at the government. This is a case where a right way to administer the tax, in this case, is someone at the Franchise Tax Board should have looked at this and said, we have enough. This is enough. It's overwhelming compliance, not just substantial compliance. And that they should have said, yes, let's let this one go. It's not worth it. It's a waste of time for administrating it this way, and it's a waste of time for it, and also that the client has participated properly in this arrangement and should be rewarded by the delay of the taxes. Let's see. And happy to say, we don't really have much more to say, so this isn't going to be one of the cases that, from our point of view, which will make you fall asleep. if you haven't already, with all due respect. So that will be the end of my presentation.
Very well. Mr. Holtz, thank you so much. Franchise Tax Board?
Thank you, David Gannigan, Franchise Tax Board. And to begin with, I think it's very clear from the Franchise Tax Board's brief that we do not agree that the Topanga property was properly identified within the 45-day period. For one, the property is never identified in itself in a written document signed by the taxpayer as potential replacement property. While the code does allow a property which is actually purchased in a completed and closed sale within the 45-day period to be considered to have been identified, actually, excuse me, it's regulations, which is 1.1031K-1, small c like cat, 4, 2 little i's, which if the property which is under contract is actually purchased, then that qualifies as identified property. But since this property is never purchased, council is wrong on the opposing side that that property is properly identified. No property is identified within the required 45-day period. In addition, it's interesting to note in the taxpayer's appeal brief, they refer to the Okmulogee Fields case twice in their case. And within the Okmulogee Fields case, which dealt with 1031, the court notes in that decision, 1031 is an exception to the general rule that the taxpayer immediately recognize gains from disposition of property. See Internal Revenue Code section 1001C. Thus, we strictly construe exceptions to the general rule of immediate recognition. Thus, we afford non-recognition treatment to an exchange only if the exchange is one which satisfies both specific descriptions in the code and the underlying purpose for which the exchange is accepted from the general rule. In addition, footnote 6 of the Okmulogee Fields case, which we reviewed later, states, the statute imposes time limits on identifying and acquiring a replacement property in order to qualify for the non-recognition treatment under section 1031A. The taxpayer must identify the replacement property within 45 days when he transfers his replacement property. The statute imposes time limits on identifying and acquiring a replacement property that reduce the amount of flexibility the taxpayer has to find and purchase replacement property. Footnote 6 goes on to state, in order to qualify for non-recognition treatment under section 1031, the taxpayer must identify the replacement property within 45 days, and so thus the 45-day mandatory ID period is confirmed twice in this opinion that opposing counsel cites. And so as we're here dealing with mechanical 45-day compliance inquiry, let's review some of the primary rules necessary to accomplish disposition of property in California without recognizing gain on the transaction. First, Internal Revenue Code section 1031A1 provides, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in trade or business or for investment. So we have to not only exchange trade or business property or investment property, the property exchange must be like kind. Like kind means trucks for trucks, jets for jets, real property for real property. In other words, personal property cannot be exchanged for real property, despite the fact it might be both trade or business properties. Internal Revenue Code section 1031A3 provides, with respect to identification requirements, any property received by the taxpayer shall be treated as property which is not like kind property if such property is not identified on or before the 45th day after the taxpayer transfers the linked property. And finally, Treasury Regulation 1.1031K-1, small d like David, two small i's, as provided in Respondent's Hearing Exhibit J provided last week. Replacement property must be substantially the same as the the replacement property received must be substantially the same as the identified replacement property to be considered received within the 180-day acquisition period. Thus, only like-kind property is eligible to be exchanged in a non-recognition transaction, and if the property ultimately acquired is not identified unambiguously in writing in the 45-day identification period, property is by law not like-kind property, regardless of whether the property is also real estate. And appellant is also not considered to have actually timely acquired the replacement property within the 180-day period, in this case as well, since the property purchased is not substantially the same as a property which was purportedly identified. As no property was identified, or even if we consider the Topanga Boulevard property identified, that same property in substantial form was not received by the appellant. So thus, the appellant blows both the 45-day test and the 180-day test. Accordingly, the non-recognition provisions of Section 1031 do not apply to this matter and gain must be recognized and included in the taxable income pursuant to Internal Revenue Code Section 1001C. In addition, I would like to briefly review the exhibits yet to be provided to your panel in this opening brief. First, Exhibit A, the Federal 1031 Exchange Reporting Form 8824, submitted with appellant's 2012 California tax return, which appellant, at line 5, erroneously claimed to have identified as Channel Road property on May 21st, 2012, a fact which we all know is incorrect. Second, appellant's California real estate broker's license is confirmed, and he has professional experience in real estate sales and closings. Third, at Exhibit C, appellant's final settlement statement, which clearly states the May 21st closing date. Fourth, at Exhibit D, appellant's related identification form, signed by appellant on July 8th, and was received actually on July 9th by the exchange company, and 3 days, but it was signed on the 3 days after the identification period terminated. Fifth, at Exhibits E, F, and G, we have further documentation, such as a Federal Reporting Form 1099-S, a mortgage full payment confirmation, and escrow statement, each clearly stating the May 21st closing date of the West Hollywood Crescent Heights property, including the letter dated May 22nd from appellant's former mortgage holder, HSBC. Thus, appellant had multiple documents confirming his May 21st sales date, and appellant's receipt of his May 22nd mortgage payoff confirmation letter from HSBC is yet another notice that appellant's property did not close on May 24th. In addition, and equally as important, an appellant's written April 30th, 2012 exchange agreement with his exchange intermediary, ANI X31, which is found in appellant's Exhibit 1, and I believe that they've been renumbered, but which was provided earlier this month in the new group of appellant's exhibits. Paragraph 5 of the exchange agreement begins with the sentence, "The taxpayer, that is appellant, shall have the sole duty and obligation to identify replacement property." Thus, appellant agreed in writing to be solely responsible for the replacement property identification, and the exchange agreement in the preceding paragraph, paragraph 4, which we can see, which has been provided to you.
Mr. Gemmingen, can I pause you for a moment there? Can you point us to exactly where you're looking?
So do you have the exchange agreement there, which
Yes.
is the first?
Yeah, that's exhibit,
So paragraph 5?
Oh, it's exhibit 1.
Paragraph 5?
Yeah.
So the first sentence there?
Okay, okay.
And then the paragraph 4, which is the preceding paragraph to that, identifies the 45-day period.
Okay.
And so that's also important too, because the appellant was aware of the 45-day period back in April, and the appellant in May was aware of the closing date. The appellant's a real estate broker, a real estate professional, and the appellant in paragraph 5 undertakes the sole duty and responsibility for ensuring compliance with the identification of the property. In addition, the exchange agreement goes on to provide that the exchange accommodator is not providing tax advice. Any other questions, Judge?
I don't have any questions.
No, I'm sorry, I'm not finished.
Oh, yeah?
I just saw that.
No, on that point, no.
Okay.
Go ahead.
Thus, we're here today due to the taxpayer's failure to timely identify as well as receive potential replacement property under requirements, Internal Revenue Code Section 1031, and regulations as incorporated in California tax law. To begin, as I mentioned earlier, respondent disagrees that appellants even identify the Topanga property as potential replacement property for purposes of Section 1031. And the appellant provided the purchase offer for the Topanga property in its recently submitted exhibits, Exhibit 4. But a thorough review of that document disclosed absolutely no statements that this property is being identified by the appellant as potential 1031 replacement property, which is ultimately irrelevant since the Penga property was never acquired. I believe if we step back for a moment to consider exactly what the appellant's really saying, and that it's okay to identify property A during the 45-day identification period, then not purchase that property A, and purchase some other property, such as property X, which is not identified during the 45-day period. I can truly understand why appellant's argument is erroneous and absolutely violates the 3 property identification rules set forth in the Internal Revenue Code section 1031. If one were allowed to identify any property, say property A, within the 45-day period, but not purchase it, and then treat the exchange as compliant with 1031, as appellant proposes here today, by purchasing some other unidentified property, then we have to ask ourselves, why do qualified intermediaries even bother with identification forms in compliance with the 45-day period? That's to say, why doesn't every exchange accommodator throughout the country and qualified intermediary already prepare pre-printed forms which identify the New York Empire State Building as an intended replacement property, and have the taxpayer sign that form on the first day of the 45-day period, or first week of that 45-day period, to ensure compliance with the 45-day identification deadline? This Empire State Building example highlights the fallacy of the appellant's position, since if his position were accepted, it would be foolish for any taxpayer to wait and determine the actual replacement property before identifying it, as opposed to simply listing the Empire State Building, since appellant maintains any other property can later be substituted for an identified property. Appellant's position actually opens up every single trade or business property across the nation as eligible replacement property, notwithstanding that none other of those properties were ever identified within the 45-day period, so long as some property, such as the Empire State Building, was identified. This wide open eligibility as to any property across the nation obviously violates the free property rule. Internal Revenue Code section 1031A3 was added to the code in 1984, setting out the 45 and 180-day timelines. Congress was concerned that the greater the discretion the taxpayer has to vary the replacement property that will ultimately be received in a transaction, the more the transaction appears to be a sale rather than exchange. This was set forth in the House of Representatives of the 90th Congress, the explanation of the Deficit Reduction Act in 1984. As explained in the 1999 PricewaterhouseCoopers article by Adam Handler and Stephanie Tran, to the extent the taxpayer is able to defer the completion of the transaction and retains the right to designate the property to be received at some future time, the transaction resembles a sale more than exchange. In other words, the greater the taxpayer's discretion to vary the particular property to be received in the exchange with the relinquished property, and to vary the date on which such property is to be received, the more transaction is appropriately treated as a sale and not a like-kind exchange. The Pricewaterhouse article then cited to the Joint Committee of Taxation's general explanation of the Tax Reform Act of 1984, pages 243 to 247. And we know a taxpayer may encounter practical difficulties trying to identify the replacement property the taxpayer will ultimately receive. The identification rules provided by the regulations balance these competing concerns in several ways. Under these rules, the maximum number of replacement properties that a taxpayer may identify is 3 properties with any fair market value, which is the free property rule, or any number of properties as long as their aggregate fair market value at the end of the identification period does not exceed 200% of the value of the linked property. In other words, double the value of the sales price of the linked property. The methodology proposed by appellant to allow the identification of property A, but then ignore this identification, not only circumvents the free property and the 200% rules, but blows them out of the water. Clearly, that's not the intent of Congress, and that's not the expectation of the general public that the tax laws will be complied with, but that other members of the public are actually complying with the tax law. Now, the basic premise of Section 1031 is that there's an exchange of properties allowing the taxpayer to avoid and allowing the taxpayer to avoid the identification rules, as proposed by appellant in this matter, destroy the purpose of the stated policy above, and take appellant's transactions outside the element of an exchange. Moreover, an additional defect in appellant's argument arises since it conflicts with Treasury Regulation Section 1.1031 K-1 small d, dealing with the receipt of identified replacement property. And a copy of this regulation was provided to the OTA and appellant last week, and it's now entitled, I believe, Exhibit J. And this regulation provides, for purpose of this section, the identified replacement property is received before the end of the exchange period. In other words, the identified property is considered received before the end of the 180-day period. Only if the taxpayer receives the replacement property before the end of the exchange period and the replacement property received substantially the same property as identified. Now, the regulations have examples about what does substantially the same mean. And there's an example of property being identified, and then the owner at that time builds a fence on the property, and then the taxpayer later acquires that property. The property of the fence is substantially the same as the property identified. However, another example, which doesn't qualify, is the taxpayer identifies 2 acres, of which there's a barn and a house sitting up within the 2 acres, and then the taxpayer later amends the purchase offer and only buys the house, the footprints of the house and the barn, and the rest of the property is not purchased. The regulations say that that property is not substantially the same, even though it's located at the same street address. So when we talk about substantially the same, we're talking about the property that's been located and identified in the ID letter, in the comparison of what was identified versus what was actually purchased.
And you're about 15 minutes, so just...
Okay, thank you. Thus, it's clear to anyone that the Channel Road property in Santa Monica, a boarded-up restaurant, which the appellant claims is a replacement property, it's not substantially the same property as the Topanga Canyon Boulevard property to the San Fernando Valley, the discount mattress store, which is the property the appellant claims he identified. Because of this material discrepancy, appellant's exchange yet again fails its basic, substantially similar to 1031 criteria. And under the regulations set forth in the respondent's recent Exhibit J, the purported identified property is not, under applicable regulations, considered received before the end of the 1031-day exchange period, and thus again, the non-recognition provisions do not apply. So please recall the May, June, July calendars earlier discussed, which the FTB submitted last week, and consider appellant's May 21st, 2012 closing date of the sale. Under the methodology provided in Example 1 of the Treasury Regulation, also illustrated on those calendars, the 45th day deadline to make a timely identification replacement property was July 5th, which we now know is a Thursday, which makes compliance from that even easier because it was an open general business day. But appellant failed to make an identification of property by that July 5th date. Moreover, while appellant ultimately purchased property in Channel Road, Santa Monica, this Channel Road property was not identified within 45 days of appellant's sale of this Crescent Heights property, and is by law considered eligible, is not considered eligible like-kind property. In conclusion, this is a very simple appeal, in that the criteria which the taxpayer failed are very mechanical tests to apply. Since the taxpayer is required by statute, found in Section 1031A3, is obligated within 45 days of relinquishing his Crescent Heights property to identify in an unambiguous writing the replacement property was received in the exchange and is provided by Treasury Regulations 1031K-1D. He must receive substantially the same property as a property which should have been identified within the 45-day period. Appellant failed both of these requirements. Therefore, as provided in Section 1031 in the Treasury Regulations, any property which the taxpayer might purchase will be treated by law as property which is not like-kind property, and thus results in the full recognition and gain of the taxpayer's sale of Crescent Heights property as determined and assessed by the respondent franchise tax code. Thank you.
Thank you, Mr. Gavin. Mr. Holtz or Mr. Burkholder, you get the last word.
Oh, thank you. Yes, Your Honor, this is Scott Burkholder for appellant. Let's start with the regulations. I just want to point out that the FTB's argument regarding the regulations having to do with the 45-day rule can only the identification is only if either the properties are identified and given to the qualified intermediary in this case before the end of the 45th day, or a property is actually purchased and transferred within that 45 days. In regulation section 1.1031, little k dash 1.
So could you read that, please?
Sure, it's actually your exhibit J.
Thank you.
Where's it? J? No, I'm sorry, H. It's exhibit H, it's on the second page, so basically it's, in that, it's section B. Oh, sorry, section C. 2, little 2I. It's in the middle of the second page. So basically down towards the bottom, it indicates that an identification of replacement property made in a written agreement for the exchange of properties signed by all the parties thereto before the end of the identification period will be treated as satisfying the requirements of paragraph C2. So if a property is identified in a contract of sale, for example, which is what we have provided in our Exhibit 4, which is dated July 5th, that would qualify under this provision of the regulation. So I just wanted to point that out first. So I believe we do have a solid recognition, identification of the property, which is evidenced by our Exhibit 4, the purchase agreement from July 5th, 2012. I don't think it's in dispute that July 5th was within the 45 days. Let's see. So that would say that properties have been identified within the 45 days. Now, the thing that's not disputed, and that we feel is overwhelming compliance, and not the fault of the taxpayer, is the fact that the other properties which he identified within the rules, within the dates that he was provided with by his qualified intermediary. That is in our Exhibit 6. You'll see that in Exhibit 6 there are 3 properties identified. The first property is the Topanga Canyon property, which he was under contract to purchase. The second one is Hacienda Place, which is not relevant. And then the third one is 100 West Channel Road, which is the property they actually purchased within the 180 days that is provided by statute. He did everything that he needed to do in terms of the information that he was provided with by a qualified professional to identify the properties within the time frame. Now, in terms of the FTB's reference to the contract between the taxpayer and the qualified intermediary in paragraph 5 of Exhibit 1, it does say that the taxpayer has the sole obligation to identify the property. It does not say that it is the taxpayer's responsibility to make sure that his representative gives him the correct date. This is not a non-delegable duty. This is not a non-delegable duty such as the responsibility to file a tax return. He can rely on his qualified intermediary, who is an expert in this. He is not, our client, Mr. Ricciardelli, is not a tax expert. He's not a CPA. He's not a tax lawyer. And yes, he is a real estate agent, but as a real estate agent, he's not the one that would take care of the 1031. So I believe that that the identification by the FTB is misplaced. That it was his sole duty under contract to keep track of those dates. Not only that, but the hyperbole with which the FTB presents the Empire State Building analogy, I think is misplaced here, because what we have is we don't have somebody who's trying to game the system. We have somebody who ended up in exactly the same place that he started. He took his investment, he put his investment into another commercial property, and all of these properties were virtually the same. He's exchanging a business property, a rental property, for another business property, which would also be a rental property, except to a business and not to an individual. He's identified exactly the correct things. He identified 3 properties. He bought one of them that was on the list. He contracted for the first one on the list, even before he turned in the list to his qualified intermediary. And he closed the sale on one of those properties within the 180 days. He's not trying to game the system. He's not trying to say, write down a list of things on the first day and say Empire State Building, and then buy something that's a complete canard. This is a man who was following everything that he thought. I mean, in our Exhibit 7, oh no, I'm sorry, not Exhibit 7. Oh, sorry.
Just a reminder, you're getting close to the agreement on time.
Okay. In Exhibit 2, you'll find that there's a letter to Mr. Ricciardelli, dated June 5th, which is a month before the actual date, which says close of 1424 North Crescent Heights, 5/24/12. And so if he looked at that and he calculated 45 days from that date, he would come up with the 8th. And that's the 45th day.
I'm sorry, you're looking at your Exhibit 5?
I'm sorry, Exhibit 2.
Exhibit 2, okay, I'm sorry.
Sorry about that. And then later, in Exhibit 3, Mr. Ricciardelli does his due diligence, and he asks his qualified intermediary, "Are you sure that we have until Sunday?" And she says, "Yes, Sunday." And then we have his list signed on the 8th, on Sunday, which he provided to his qualified intermediary. So I think that the idea that finding in favor of the taxpayer in this case would be the undermining of the statute, the Empire State Building, I think is overstated, and I don't really think that that's something that we're in danger of here by finding for the taxpayer. And again, he ended up in exactly the position that Congress anticipated that somebody who did the right thing would. He ended up taking all of the money that he got from the sale of the property and investing it into another property. There was no cash, there's no boot, there's nothing that he profited on from there. And so having his tax deferred is actually the correct thing to do in this case.
And if, with your permission, I'm gonna make this quick. Do I have?
Briefly, thank you.
Very good. Okay, very quickly. One thing I want to mention, there's only two issues. One thing I want to mention is opposing counsel indicated that the appellant, by reason, I guess, of the exhibit of the contract, was aware of the closing date, the other one. I don't think that's a fact. There's no information in the record that shows he was aware or would have known and had awareness of that date. He's implying that from the fact that there was a contract, that just as a matter of fact. Second thing is, the reason why I made the presentation about this being a case about the administration of tax law is we have other strict, they're suggesting this is strict compliance. We have lots of areas in tax law where one would say we have strict law requirements for substantiation. For instance, 274D for meals and entertainment. I worked at the IRS, I've worked for years now on the other side. You, and I'm sure many of you have been in the practice of tax, audit, defense, and so forth on both sides. The rule for strict substantiation is that you have to prove contemporaneous evidence to prove meals and entertainment. So who in the universe would ever get a deduction unless they kept the calendar for every one of these things? Now, the way it has been administered fairly and correctly by the Internal Revenue Service and many administrations, and the way I see it day in, day out again, is that there is still this attempt to apply a fair result. I don't have to tell my clients that if they don't have a calendar, they don't have perfect proof of all their meals and entertainment, they're not going to get it. No, I tell them that don't worry, we're going to get a fair result here because the government, the IRS, is going to achieve that. And in particular, when I was a young attorney, one of my first cases in front of Judge Nonrath at the U.S. Tax Court, I had a case where the person had no documents of any of their Schedule C expenses. And I went to the judge with a lot of power and feelings of this is going to be a great case for me. And I said, Your Honor, they asked me what the position is. The client has no documents for their Schedule C business. The judge leaned over to me and said, do you, sir, are you taking the position that there is no business? And I said, no. Are you taking the position that he had no business expenses? I said, no. I'm just taking the position he doesn't have documents to substantiate. And he says, Mr. Holtz, I want you to go back there and work this out because you're going to make me have to guess this because I'm here for justice. I'm here to administer the tax law. So if you're able to see this case from my perspective, and even if you are unable to achieve the result that we're seeking, I hope that you'll put memorandum in the case, if you can, and you see fit, to instruct this taxing agency to act reasonably in the future. It's about fairness of our taxing system and about us going forward and dealing with our opposing counsel and all the people in the system to create a system that works better for everybody, that is fairly administered. It's administered in the right way. And that's all I have to say. Thank you for the extra time.
Thank you, Mr. Holtz and Mr. Burkholder. So that comes to the conclusion of the presentations. Do my co-panelists have any questions for the appellant or the FTB?
Do you have some quick questions for appellant in this matter? Mr. Burkholder, you had mentioned that the taxpayer had identified the property as evidenced by Exhibit 4. Is there a particular language in Exhibit 4 that might demonstrate that this has been identified as replacement property?
Your Honor, no. There's nothing in the contract that indicates that this is a property for a 1031 exchange. However, I don't believe that the regulation, as I read it to you, requires that.
Thank you. My second question is for Mr. Holtz. I don't want to put words in your mouth, but it sounded to me that you were making argument almost as if we should apply substance over form in this case, treating this as an exchange transaction, even though the strict requirements of the statute and the regulation have not been met. Is there any authority anywhere, any federal authority that you might be aware of where a taxpayer has succeeded or prevailed, where they have not met all the requirements, certain requirements of
Regarding,
the law?
Regarding 1031s?
Correct.
I am not aware of one pro or against that in this case. In situations like this, I would suggest that you have a first impression case. Have you ever seen one this close? In other words, have you ever seen one slide by that close? And that's why I'm saying, and I mean it with passion, that we shouldn't be here. Somebody at the FTB, and that's why I'm hoping you'll send a signal, even if you can't hold for us, should have just said, no, don't go after the $2. Enough is enough. This is not just substantial compliance. This is overwhelming compliance, and this barely missed. And that's our case.
Thank you. Judge Johnson?
Yes, thank you, Judge Ewing. For appellants, I think one item that's been raised, and I don't know if we got your opinion on it, your discussion regarding it, was the Form 8824 with the claimed identification date of May 21st, 2012. Can you explain why that date was used on that form?
No, Your Honor, I didn't, I wasn't referring to the tax return or any of the forms that were filled out later. Really, our focus is on what happened at the time when the 45-day period passed and then when the 180-day period passed.
Okay. And may not have any bearing here, but do you know if there was any inspection by the IRS on this transaction?
There wasn't, no.
A separate question now. For the Topanga property, I know you made the argument that the entering into the agreement to make the purchase qualifies for identification of replacement property, even though the Topanga property is ultimately never required.
Correct.
And maybe this goes towards FTB's point they made during their arguments. Is that to suggest that you can meet the identification qualification or requirement with one property while purchasing a different property later on?
This is, as Dave was saying, this is a case, I haven't seen this fact pattern before, where you have the actual identification of a property that is on the list of 3 properties that was, that was given to the qualified intermediary 72 hours after the deadline, but provided with the full confidence that he was doing so in a timely manner. So it's not like he identified the Topanga property by contract and then 3 months later or 5 months later there was another property which he liked better and then dropped the Topanga property and picked up the one that hadn't been identified at all. This one had been identified. It was just identified late. And I understand the FTB's point in terms of the strictness of the statute, but I haven't found a case that's this close. I haven't found a case that has ruled on this particular fact pattern. As I look at the exhibits that the FTB has provided, the extra exhibits, when I'm looking at their Exhibit L, Kunkel v. Commissioner, they're citing a case where a property was identified and then it fell out. And then there was another property that they purchased 410 or 470 days later that then they tried to get 1031 treatment for. This is not that case. This is a case of, this is like a case where the property was identified within the time frame that the taxpayer thought was within the statute and had been provided that information more than once in writing, and then with good faith proceeded to purchase one of those 3 properties within the 180-day period.
And to clarify, when the incorrect date was given by the qualified intermediary, You're not suggesting that actually extended the limitations under IRC 1031. You're just saying that it goes towards a reasonable attempt to comply by the taxpayer. Is that correct?
That's correct.
Okay. If we could look at Exhibit H, which is the Treasury regulation from Franchise Tax Board.
Yes.
And just speaking towards the closeness, the number of days, the 72 hours that you mentioned here. If we look at, let's see, Exhibit H, lower C.
Yes.
And then it's confusingly structured, but under 3, then it goes to 7 with examples.
Yes.
So that example provided there, C7, example 1, it provides a identification period that expired July 1st, 1991. And then in example 1, they provide the identification on July 2nd, 1991, 1 day later. You see example 1.
I'm sorry, I'm a little
Oh,
off.
sure. It's the final page, page 3.
Page 3.
Page 3.
Exhibit
Okay.
H.
Right. In the middle, there's example 1.
Yes, I see it.
So up above the prior paragraph where it laid out the fact pattern, it showed that the 45-day identification period expired on July 1st. It's the very last sentence of the previous page. And then they provided identification on July 2nd, so literally the next day. And then the answer there in the small 2 I's is that that identification is late and therefore does not qualify as like-kind property. Do you care to discuss that example and how it may apply to this situation?
Certainly. This example is similar to what we're talking about, except for the fact that there's no indication that the time period had been provided to them by a qualified intermediary as incorrect, and that you can't rely on that. That doesn't say that you can't rely on the advice of an expert professional. I mean, I understand the point here, but this is at least, I guess, is assuming that they knew what the actual date was. It doesn't say they mistakenly provided the list on the 2nd. That they didn't know what the actual date was.
Okay, I'll just intervene in a second, but or it could also be just strict reading of the requirements with no intent or assumed knowledge kind of imparted in application of the law. Could that also be true?
Yes.
In Franchise Tax Board, you want to speak to any of that?
Yeah, I beg your pardon, but I'd just like to address a comment made that the taxpayer had no indication of the incorrect date. And actually, at Exhibit 2 of the taxpayer's recent submissions, which is the ANI X31 letter, which is dated June 5th, which was provided about 2 weeks ago. Do you have that available? So within that letter, it lists in the middle of the page the closing date, the 45th date, and the 180th date. And we're talking about property identification here and the need to submit the identification form. But if we read along further, the underlined last sentence says, please complete and date and scan back the enclosed notice of identification on or before November 20th, 2012. Now, anyone reading this letter would have obviously noticed that 2 different dates are provided for the identification. And so the taxpayer did have notice as to the faulty identification date. Should have done corrective work and measured, and contrary to the opposing counsel's statement, they had no notice. This clearly sets forth notice of inconsistent dates, and thus the taxpayer did have notice that the dates provided by the exchange company were questionable. As to what, but you know, as we briefed it, intent is not enough to satisfy the statutory requirements. Thank you.
Thank you. Certainly does show. I'll respond real quick, and then I'll come back to you. Sure. Certainly does show that perhaps there was a clerical mistake made in the underlying part, and perhaps does draw the entire document to question. Although I'm not sure if you would take one clerical mistake and then assume that other numbers might also be off for different reasons. But I tend to agree that when dealing with important dates and deadlines, that you should be careful. Start correct that, and then have appellants also
Just
respond.
real quick, if he was addressing my comment was that he stated, and it would seem to be, he was stating a fact, that my client was aware of the deadlines, and my point is there's no evidence. Okay, good.
Yes, and in terms of that, if we're talking about the taxpayer being careful and proceeding due diligence, I believe that Exhibit 3, the email, in which he confirms again the date of July 8th, would put that to rest.
Okay. So what I see are perhaps mistakes made at the qualified intermediary position, sort of a reasonable reliance and a substantial compliance kind of situation set forth here. And I don't mean to reiterate what Judge Daines already asked, but is there case law or regulations or statutory that says that any of those mistake of facts, reasonable, substantial compliance but not full compliance, any of those kind of elements, is there law supporting that can allow you to satisfy an otherwise incorrect identification period?
As I said before, I have not been able to find any fact pattern that is like this, where you have the identification of the property through contract, and then you have a list that's dependent on the expert advice of the qualified intermediary. That's been decided by a court. No, we haven't been able to find it.
Okay, and then thank you, Judge. One more question, if I may, actually. Sorry, it takes so much time. Franchise Tax Board, in the calendar that you provided, I think you make a clarification regarding something mentioned on page 5 of your brief. See if I can find that again.
Yeah, we mentioned July 6th as the 45th date, and then July 8th as the 48th date. And just wanted to correct the date as July 5th date, and that's the reason why I included the regulations example to show how the regulation calculated 45 days on this calendar, and then also calculated for the taxpayer. So I just wanted to correct our misstatement of July 6th as being the 45th date and just demonstrate why it's the
Okay, so essentially moving everything back one day.
Yes, that's right.
Okay. And then when you do have, it looks like it's May 17th, there's a regulation, it says transfer date May 17th, and then the 18th would be day 1. Is that related to the facts here, or is that your example there?
No, that's not my example, it's the example from the regulations. The regulations gives the dates, and then that's how to do the countdown.
Okay, thank you.
And pardon me, the regulation is found at the, up there in the May calendar. I have the regulation cited, 1031K-1C7, and then the example 1. So it's found in the regulations.
Thank you.
Any more questions? No? Well, with that, we thank all of you very much for your time. Mr. Burkholder, Mr. Holtz, Mr. Gimmigan, Ms. Kudak, thank you very much for your time today, and we will be in touch with you soon. Thank you.
Thank you.
Oh, this closes the record on this case.